Welcome to Financial Foundations, essential skills for managing your money after college. The importance of financial literacy. As young adults transition from the structured environment of college to the complexities of independent living, the significance of financial literacy cannot be overstated. The ability to manage personal finances effectively is a crucial skill that lays the groundwork for a secure and prosperous future. The journey of financial independence begins with understanding fundamental concepts such as budgeting, debt management, saving, investing, and navigating taxes. In a world where financial decisions can have long-lasting implications, equipping oneself with essential skills is not merely beneficial, but necessary for achieving long-term financial stability. This course, Financial Foundations, Essential Skills for Managing Your Money After College, is designed to empower recent graduates with the knowledge and tools necessary to take control of their financial destinies. By exploring various aspects of personal finance, participants will learn to create a personalized budget, effectively manage debt, and develop strategies for saving and investing. Understanding the intricacies of insurance, taxes, and wealth-building principles will further enhance their ability to make informed decisions. This course focuses on practical applications and real-world scenarios. It aims to cultivate a mindset of financial responsibility and adaptability, preparing individuals to not only navigate the challenges of their early careers, but also thrive in their financial lives for years to come. What is financial literacy? Financial literacy is the ability to understand and effectively use various financial skills, including personal financial management, budgeting, and investing. In today's complex financial landscape, being financially literate is crucial for recent college graduates as they transition into adulthood and begin to manage their own finances. Empowerment through knowledge. Understanding financial principles empowers individuals to make informed decisions about their money. Financial literacy enables graduates to comprehend essential concepts such as interest rates, credit scores, and investment strategies. With this knowledge, they can navigate financial products and services more effectively, ensuring that they choose options that align with their financial goals. Budgeting and money management. One of the cornerstones of financial literacy is the ability to create and manage a budget. Recent graduates often face new expenses, such as student loan repayments, rent, and utilities. A solid understanding of budgeting helps them allocate their income wisely, prioritize spending, and avoid unnecessary debt. This skill is essential for achieving long-term financial stability and success. Understanding credit. Credit plays a significant role in an individual's financial journey. Financial literacy helps graduates understand how credit works, including the factors that affect credit scores and the long-term implications of borrowing. By grasping these concepts, they can make strategic decisions regarding credit cards, loans, and mortgages, ultimately improving their financial standing. Investment knowledge. Investing is a vital component of building wealth over time. Financial literacy equips graduates with the knowledge necessary to explore different investment opportunities, such as stocks, bonds, and mutual funds. Understanding risk tolerance, diversification, and market trends enables them to create a balanced investment portfolio that aligns with their financial objectives. Avoiding financial pitfalls. With a solid foundation in financial literacy, graduates can identify and avoid common financial pitfalls such as high-interest debt, inadequate savings, and poor investment choices. By recognizing these dangers, they can develop strategies to mitigate risks and protect their financial future. Long-term financial planning. Financial literacy is not just about handling day-to-day expenses. It also involves planning for the future. Graduates who are financially literate are better prepared to set and achieve long-term financial goals, such as saving for retirement, purchasing a home, or funding education for future generations. This forward-thinking approach is essential for achieving financial independence and security. Building confidence. Finally, financial literacy fosters confidence. When graduates understand their finances, they are more likely to take proactive steps toward achieving their financial goals. This confidence can lead to better decision-making, increased savings, and a more secure financial future. Overview of personal finance concepts. Personal finance encompasses the management of an individual's financial activities, including budgeting, saving, investing, and planning for future financial needs. For recent college graduates, understanding these concepts is crucial for establishing a secure financial foundation. 1. Budgeting. Budgeting is the process of creating a plan to spend your money. It helps track income and expenses to ensure that you are living within your means. A well-prepared budget considers fixed expenses, like rent and utilities, variable expenses, such as groceries and entertainment, and savings. Key steps in budgeting: calculate total income. Include all sources of income, such as salary, side hustles, or passive income. List all expenses. Document all monthly expenses to understand where your money goes. Create categories. Organize expenses into categories to identify areas for potential savings. Adjust as needed. Review and adjust your budget regularly to reflect changes in income or expenses. 2. Saving. Saving is essential for financial security and achieving long-term goals. It's advisable to set aside a portion of your income for both short-term and long-term savings. Short-term savings can cover unexpected expenses, while long-term savings may be directed towards retirement or significant purchases. Types of savings accounts. Traditional savings account. A basic account with lower interest rates, ideal for emergency funds. High-yield savings account. Offers better interest rates, suitable for savings goals. Certificates of deposit. CDs, time-bound deposits with higher interest rates, best for funds not needed for a certain period. 3. Investing. Investing involves allocating money to assets with the expectation of generating a return. It is a vital component of building wealth over time. Understanding different types of investments, risk tolerance, and market dynamics is crucial for making informed decisions. Types of investments. Stocks. Ownership shares in a company that can offer high returns but come with higher risk. Bonds. Loans to entities, government or corporations, that pay fixed interest over time, generally considered lower risk. Mutual funds. Investments pooled from many investors to purchase a diversified portfolio of stocks and bonds. Real estate. Involves purchasing property for rental income or appreciation. 4. Credit management. Credit management is the practice of using credit wisely to build a solid credit history. A good credit score is essential for securing loans, renting apartments, and more. Understanding how credit works, types of credit, and maintaining a good credit score is fundamental. Tips for managing credit. Pay bills on time. Timely payments positively impact your credit score. Keep credit utilization low. Aim to use less than 30% of your available credit. Check your credit report. Regularly review your credit report for errors and dispute any inaccuracies. 5. Insurance. Insurance is a risk management tool that protects against financial loss. Understanding different types of insurance is crucial for safeguarding your assets and ensuring financial stability. Common types of insurance. Health insurance. Covers medical expenses and is essential for financial protection against health-related costs. Auto insurance. Protects against financial loss from accidents or theft of your vehicle. Renter's insurance. Covers personal belongings in a rented space and provides liability protection. Life insurance. Provides financial support to beneficiaries in the event of the policyholder's death. 6. Retirement planning. Retirement planning involves preparing financially for life after work. Starting early with retirement savings can lead to significant growth over time due to compound interest. Understanding retirement accounts and employer-sponsored plans is vital. Types of retirement accounts. 401k. An employer-sponsored retirement plan that often includes matching contributions. IRA. Individual retirement account, a personal retirement savings account with tax advantages. Roth IRA. A type of IRA that allows for tax-free withdrawals in retirement. 7. Financial goals. Setting financial goals is essential for guiding your financial decisions. Goals can be short-term, like saving for a vacation, medium-term, such as buying a car, or long-term, like retirement. Defining specific, measurable, achievable, relevant, and time-bound, SMART, goals can help in effective planning. Steps to set financial goals. Identify your priorities. Determine what is most important to you financially. Set realistic timelines. Assign timeframes for achieving each goal. Create an action plan. Outline the steps needed to reach each goal. Review and adjust as necessary. Regularly check your progress and make adjustments to your plans if needed. Creating a budget. Understanding income and expenses. Managing personal finances starts with a clear understanding of your income and expenses. This foundational knowledge will empower you to make informed financial decisions as you transition into post-college life. What is income? Income refers to the money you receive on a regular basis. For recent college graduates, income can come from various sources, including salary, the most common source of income derived from your job after graduation, freelancing or gig work. Many graduates take on freelance projects or gig economy jobs for additional income. Investments, earnings from stocks, bonds, or other investment vehicles. Passive income, money earned from rental properties, royalties, or other sources that require little active involvement. Understanding your salary. Your salary is often presented as a gross amount, which is the total you earn before taxes and other deductions. It's essential to understand your net income, which is the amount you take home after these deductions. Here are some key components: federal and state taxes. These are mandatory deductions from your paycheck based on your income level and location. Social Security and Medicare. Contributions to these federal programs are also deducted from your gross income. Retirement contributions. If your employer offers a retirement plan, contributions to this plan may be deducted from your paycheck. What are expenses? Expenses are the costs incurred in your daily life. Understanding your expenses is crucial for effective budgeting. These can be categorized into fixed expenses, regular, unchanging costs such as rent, student loans, and insurance premiums. Variable expenses, costs that fluctuate each month, including groceries, dining out, and entertainment. Discretionary expenses, non-essential spending, such as hobbies, vacations, and luxury items. Tracking your income and expenses. To effectively manage your finances, it is vital to track both your income and expenses. Here are some methods to do so. Spreadsheets. Create a simple spreadsheet to log your income and expenses each month. Budgeting apps. Utilize apps designed for budgeting that can automatically track and categorize your spending. Bank statements. Regularly review your bank statements to keep an accurate account of your finances. Creating a budget. Once you have a clear understanding of your income and expenses, the next step is to create a budget. A budget helps you allocate your income to cover necessary expenses, while also allowing for savings and discretionary spending. Here's how to create one. List all sources of income. List all fixed and variable expenses. Subtract total expenses from total income to determine your remaining balance. Allocate funds for savings and discretionary spending based on your remaining balance. Adjusting your financial plan. Your financial situation may change over time due to new job opportunities, changes in expenses, or unexpected financial events. It's important to regularly review and adjust your budget and financial plan accordingly. This will ensure that you remain on track to meet your financial goals. By understanding your income and expenses, you equip yourself with the knowledge needed to make sound financial decisions, ultimately leading to greater financial stability and success after college. Tracking income sources. Understanding and tracking your income sources is crucial for effective financial management, especially as a recent college graduate entering the workforce. This practice not only helps you gain a clear picture of your financial situation, but also aids in budgeting, saving, and planning for future expenses. Identifying income sources. The first step in tracking your income is to identify all potential sources of income. Common sources for recent graduates include salary or wages. This is your primary source of income if you are employed full-time or part-time. Freelance work. If you take on freelance projects or gigs, include this income as well. Investments. Income from stocks, bonds, mutual funds, or real estate can contribute to your overall income. Side hustles. Any additional work outside your primary job, such as tutoring or selling products online. Passive income. Revenue generated from sources like rental properties or royalties from creative work. Creating a tracking system. Once you have identified your income sources, the next step is to create a system for tracking them. Here are a few methods you can consider. Spreadsheets. Use software like Microsoft Excel or Google Sheets to create a detailed income tracker. You can create columns for the income source, amount, date received, and any notes. Financial apps. There are numerous apps designed for personal finance management that allow you to track income and expenses in one place, such as Mint, Inab, You Need a Budget, or Personal Capital. Manual tracking. If you prefer a traditional approach, keep a dedicated notebook or journal where you record your income manually. Regular updates. To maintain an accurate understanding of your financial situation, it's important to update your income tracker regularly. Set a schedule, whether weekly or monthly, to log your income and review any changes. This practice will help you stay on top of your finances and make informed decisions. Analyzing your income trends. Tracking income is not just about recording numbers. It's also about analyzing trends. Look for patterns in your income over time. Are there certain months when you earn more due to bonuses or seasonal work? Understanding these patterns can help you plan for months when income might be lower. Setting financial goals. Once you have a clear picture of your income, you can set realistic financial goals. This can include saving a certain percentage of your income, paying down student loans, or building an emergency fund. Knowing your income sources allows you to allocate funds effectively towards these goals. In summary, tracking your income sources is a fundamental skill for managing your personal finances after college. It helps you understand your financial landscape, make informed decisions, and set achievable goals. By implementing a reliable tracking system and regularly reviewing your income, you position yourself for greater financial success in the future. Identifying fixed and variable expenses. Understanding your expenses is crucial for effective personal finance management. Expenses can be categorized into two main types: fixed expenses and variable expenses. Each type plays a significant role in your overall financial picture. Fixed expenses. Fixed expenses are costs that do not change from month to month. These expenses are often contractual obligations or recurring payments that you can anticipate and plan for. Common examples of fixed expenses include rent or mortgage payments, monthly payments for housing that remain consistent throughout the lease or loan term, insurance premiums, payments for health, auto, or renter's insurance that are billed regularly, student loan payments, fixed monthly payments you must make after graduation, depending on your loan agreement, subscription services, monthly or annual fees for services like streaming platforms or gym memberships that are consistent. Identifying your fixed expenses helps you establish a baseline for your monthly budget and ensures that you prioritize these necessary payments. Variable expenses. Variable expenses, on the other hand, fluctuate from month to month. These costs can vary based on your lifestyle, spending habits, and choices. Common examples of variable expenses include groceries. The amount you spend on food can change based on your preferences and dietary needs. Utilities. Monthly bills for electricity, water, gas, and internet that can vary depending on usage. Entertainment. Costs associated with dining out, movies, concerts, or other leisure activities. Transportation. Expenses related to gas, public transportation, and vehicle maintenance that can differ each month. Monitoring your variable expenses is essential for understanding your spending patterns and finding areas where you can cut back when necessary. Strategies for identifying and categorizing expenses. To effectively manage your finances, you can employ several strategies to identify and categorize your expenses. Track your spending. Use budgeting apps or spreadsheets to monitor all of your expenditures over a few months to gain insights into your spending habits. Review bank statements. Look through your bank and credit card statements to identify recurring charges and categorize them as fixed or variable. Set a budget. Create a budget that allocates funds for both fixed and variable expenses, ensuring that essential payments are covered first. Adjust as necessary. Regularly review your expenses and adjust your budget to reflect any changes in income or spending patterns. By understanding the difference between fixed and variable expenses, you can make informed financial decisions that lead to better money management and long-term financial stability. Developing a personal budget. Creating a personal budget is a crucial step in managing your finances effectively after college. A budget helps you track your income and expenses, ensuring you live within your means and work towards your financial goals. Understanding your income. The first step in developing a personal budget is to determine your total income. This includes your salary, any side jobs, or freelance work. For those who may have variable incomes, such as freelancers, it is advisable to calculate an average monthly income based on past earnings. Identifying your expenses. Next, categorize your expenses. Common categories include fixed expenses. These are regular monthly payments that do not change, such as rent, utilities, and loan payments. Variable expenses. These fluctuate month to month, including groceries, entertainment, and dining out. Savings and investments. Allocate a portion of your income for savings, retirement accounts, or investments. Tracking your spending. To develop an accurate budget, track your spending for at least a month. You can use budgeting apps, spreadsheets, or even pen and paper. Document every expense to identify spending patterns and areas where you can cut back. Creating the budget. Once you have a clear picture of your income and expenses, you can create your budget. Follow these steps. List your total monthly income. List all your expenses by category. Subtract your total expenses from your total income. This will help you determine if you are living within your means or if adjustments are necessary. Implementing the budget. After establishing your budget, it's essential to implement it. Stick to the budget you've created and regularly review your spending to ensure you remain on track. Adjust your budget as necessary based on changes in income or expenses. Reviewing and adjusting your budget. Life circumstances change, and so should your budget. Review your budget regularly, monthly or quarterly, to assess your financial situation and make adjustments. This practice ensures your budget remains relevant and effective. Utilizing budgeting tools. Consider using budgeting tools and apps to simplify the process. Many tools allow you to connect your bank accounts, categorize expenses automatically, and provide insights into your spending habits. Popular options include Mint YNAB, You Need a Budget. Every dollar. Developing a personal budget is a foundational skill for managing your finances after college. By understanding your income, tracking your expenses, and regularly reviewing your budget, you can achieve financial stability and work towards your financial goals. Setting financial goals. Setting financial goals is a crucial step in managing your personal finances effectively. It provides direction and a clear roadmap for your financial journey. By identifying what you want to achieve financially, you can create actionable steps to turn your aspirations into reality. Why set financial goals? Financial goals help you prioritize your spending and saving habits. They encourage you to think about your future and motivate you to make better financial decisions. Establishing goals can also help you track your progress and adjust your strategies as needed. Types of financial goals. Financial goals can generally be categorized into three main types. Short-term goals. These are objectives you want to achieve within a year. Examples include saving for a vacation, paying off a credit card, or building an emergency fund. Medium-term goals. These goals typically span 1 to 5 years. Examples include saving for a car, a down payment on a home, or funding further education. Long-term goals. These are objectives that require more than 5 years to achieve. Examples include saving for retirement, children's education, or buying a home. How to set effective financial goals. To set effective financial goals, consider the following steps. Be specific. Clearly define your goals. Instead of saying, I want to save money, specify an amount and a timeline, such as I want to save $5,000 for a vacation in 18 months. Make them measurable. Establish criteria to measure your progress. This could involve tracking savings in a dedicated account or using budgeting apps to monitor your expenses. Ensure they are achievable. Your goals should be realistic and attainable based on your current financial situation. Consider your income, expenses, and other financial commitments. Set relevant goals. Your financial goals should align with your values and long-term objectives. Think about what matters most to you and ensure your goals reflect those priorities. Time-bound. Assign a deadline to each goal. This helps create a sense of urgency and encourages you to take action. Review and adjust your goals. It's essential to review your financial goals regularly and make adjustments as needed. Life circumstances change, and your goals may need to evolve. Set a schedule for reviewing your goals, quarterly, biannually, or annually, to assess your progress and make any necessary adjustments. Setting financial goals is a foundational skill for recent college graduates who want to manage their money effectively. By understanding the types of goals, learning how to set them, and regularly reviewing progress, you can create a solid financial future. Understanding fund allocation. Allocating funds effectively is a crucial aspect of managing your personal finances. After college, many graduates encounter various financial responsibilities, making it essential to distribute their income wisely across different categories. This ensures that all necessary expenses are covered, while also allowing for savings and investments. Below are key categories to consider when allocating your funds. Fixed expenses. Fixed expenses are costs that do not change from month to month. These include rent or mortgage payments, utilities, electricity, water, gas, insurance, health, car renters, loan payments, student car. It is advisable to allocate a significant portion of your income to cover these essential fixed costs, as failure to do so can lead to financial instability. Variable expenses. Variable expenses fluctuate and can be adjusted based on your lifestyle choices. Common variable expenses include groceries, transportation, gas, public transit, entertainment, dining out, movies, clothing. Monitoring these expenses is important, as they can significantly impact your budget if not controlled. Set a reasonable limit for these categories to avoid overspending. Savings and emergency fund. It's vital to set aside a portion of your income for savings and emergencies. This category can include emergency fund, 3 to 6 months of living expenses, savings for short-term goals, vacations, major purchases, retirement accounts, 401k, IRA contributions. A good rule of thumb is to aim for saving at least 20% of your income. This prepares you for unexpected expenses and helps build a secure financial future. Investments. Investing is a key component of wealth building. As a recent graduate, you may consider allocating funds to stock market investments, stocks, ETFs, real estate, if feasible, other investment vehicles, bonds, mutual funds. Investing early can significantly impact your long-term financial health due to the power of compound interest. Start with a small percentage and gradually increase your investment as your financial situation improves. Discretionary spending. Discretionary spending encompasses non-essential expenses that enhance your lifestyle. This can include hobbies, travel subscriptions, streaming services, magazines. While it's important to enjoy your earnings, be mindful of how much you spend in this category. Setting a specific budget for discretionary spending can help you enjoy life without compromising your financial goals. Creating your allocation plan. To create a successful fund allocation plan, track your income and expenses for a month to understand your financial situation. Determine your priorities for each category based on your needs and goals. Use the 50/30/20 rule as a guideline, allocating 50% to needs, 30% to wants, and 20% to savings and debt repayment. Adjust your allocations as needed based on changing circumstances, such as new job opportunities or unexpected expenses. Using budgeting tools or apps can also ease the process of tracking and managing your allocations effectively. Tools and apps for budgeting. Managing personal finances can be challenging, especially for recent college graduates. Fortunately, there are numerous tools and apps available that can help you track your income, expenses, and savings goals effectively. Below, we explore some popular options that can aid in budgeting. 1. Budgeting apps. Budgeting apps are designed to simplify the process of tracking your finances. They often come with user-friendly interfaces and features that can help you understand your spending habits. Mint. Mint is a free budgeting tool that allows users to connect their bank accounts, credit cards, and bills. It automatically categorizes transactions and provides insights into spending patterns. Users can set budgets and receive alerts when they exceed their limits. In-app, You Need a Budget. In-app is a subscription-based service that focuses on helping users allocate every dollar they earn to specific expenses. It encourages proactive budgeting and offers educational resources to help users improve their financial literacy. Every Dollar, created by financial expert Dave Ramsey. Every Dollar offers a simple drag-and-drop interface for budgeting. The app allows users to create monthly budgets and track expenses easily. 2. Expense trackers. Expense tracking apps help you monitor your spending in real time, allowing you to identify areas where you may need to cut back. Expensify. Expensify is ideal for tracking daily expenses, especially for those who travel frequently. It allows users to take photos of receipts and generate expense reports. It integrates with accounting software for seamless financial management. Spendee. Spendee is a visually appealing app that allows users to track expenses in different currencies. It supports shared wallets, making it perfect for couples or roommates who want to manage joint expenses. 3. Savings and investment tools. In addition to budgeting and expense tracking, there are apps that focus on savings and investment, helping you grow your wealth over time. Acorns. Acorns is an investment app that automatically rounds up your purchases to the nearest dollar and invests the spare change. This is an effortless way to start investing without having to think about it. Capital. Capital allows users to set savings goals and create rules for saving. For example, you can set a rule to save a specific amount every time you make a purchase or reach a workout goal. 4. Financial management platforms. Comprehensive financial management platforms combine budgeting, expense tracking, and investment monitoring in one place. Personal Capital. Personal Capital provides tools for budgeting, expense tracking, and investment management. It offers a holistic view of your financial situation, allowing you to plan for retirement and track your net worth. Truebill. Truebill focuses on managing subscriptions and recurring payments. It helps users identify unwanted subscriptions and negotiate bills, making it easier to save money. 5. Spreadsheet solutions. For those who prefer a more hands-on approach, spreadsheets can be an effective way to budget. Google Sheets. Google Sheets offers customizable budgeting templates that you can use to track your income and expenses. You can share your sheets with family members or a financial advisor for collaborative budgeting. Excel. Microsoft Excel is another powerful tool for budgeting. It allows for complex calculations and data analysis, making it suitable for users who want to dive deeper into their financial data. 6. Financial education resources. Many budgeting apps and platforms also provide educational content, helping users improve their financial literacy. Look for resources such as articles, webinars, and interactive tools that can enhance your understanding of personal finance. Choosing the right budgeting tool or app depends on your personal preferences, financial goals, and the level of complexity you are comfortable with. Experiment with managing debt. Let's look at the different types of debt. Understanding the various types of debt is crucial for recent college graduates as they navigate their financial lives. Debt can broadly be classified into two categories: secured and unsecured debt. Each type has its own characteristics, implications, and management strategies. Secured debt. Secured debt is backed by collateral, which means that the lender has the right to take possession of the asset if the borrower fails to repay the loan. This type of debt often comes with lower interest rates because it is less risky for lenders. Examples of secured debt: mortgages. Loans taken out to purchase real estate, where the property serves as collateral. Auto loans. Loans for purchasing vehicles, with the vehicle itself securing the loan. Secured personal loans. Personal loans that require collateral, such as savings accounts or other assets. Unsecured debt. Unsecured debt is not backed by any specific asset. Because lenders cannot claim any property to recover their losses, this type of debt typically carries higher interest rates. Borrowers are often required to have a good credit score to qualify for unsecured loans. Examples of unsecured debt: credit cards. Revolving credit accounts that allow borrowers to spend up to a certain limit without collateral. Student loans. Loans taken out for education expenses, which may be federal or private, and usually do not require collateral. Personal loans. Loans that can be used for various purposes, including debt consolidation or emergencies, without collateral. Types of debt by purpose. Debt can also be classified based on its purpose, which helps individuals understand their financial commitments better. Consumer debt. Consumer debt encompasses loans taken out for personal consumption, including credit card debt, personal loans, and retail financing. This type of debt is often characterized by high interest rates and can lead to financial difficulties if not managed properly. Investment debt. Investment debt refers to loans taken out to finance investments, such as real estate purchases or business ventures. While this type of debt can lead to wealth accumulation, it also carries risks, particularly if the investment does not yield a positive return. Mortgage debt. Mortgage debt is specifically related to loans for purchasing property. It is typically one of the largest financial commitments an individual will make and can span many years, often 15 to 30 years. Understanding interest rates. Regardless of the type of debt, understanding interest rates is essential. Interest rates can vary significantly between secured and unsecured debt, and they can impact the total cost of borrowing. Fixed rates remain constant throughout the loan term, while variable rates can fluctuate based on market conditions. Strategies for managing debt. For recent graduates, managing debt effectively is vital for financial health. Here are some strategies. Create a budget. Track income and expenses to understand where money is going and how much can be allocated to debt repayment. Prioritize debt repayment. Focus on paying off high-interest debt first to reduce overall interest costs. Consider debt consolidation. Explore options for consolidating multiple debts into a single loan with a lower interest rate. Seek professional advice. If overwhelmed, consider consulting a financial advisor for tailored strategies. Understanding student loans. Student loans are a significant aspect of many recent graduates' financial lives. They provide the necessary funds to cover tuition, fees, and living expenses while pursuing a degree. However, managing student loans effectively is crucial for maintaining financial stability after college. Types of student loans. There are two main categories of student loans: federal and private loans. Federal loans. Federal student loans are funded by the government and typically offer lower interest rates and more flexible repayment options. They include direct subsidized loans, available to undergraduate students with demonstrated financial need. The government pays the interest while you are in school. Direct unsubsidized loans, available to undergraduate and graduate students. Interest accrues during all periods, including while you are in school. Plus loans. Parent loans for undergraduate students or graduate students. These loans require a credit check and typically have higher interest rates. Private loans. Private student loans are offered by banks, credit unions, and other financial institutions. They may have variable interest rates and less flexible repayment options compared to federal loans. Borrowers often need a good credit score or a cosigner to qualify for these loans. Loan repayment options. Understanding your repayment options is essential. Here are some common repayment plans for federal student loans. Standard repayment plan. Fixed monthly payments over a period of 10 years. Graduated repayment plan. Payments start low and increase every 2 years, also over a period of 10 years. Income-driven repayment plans. Payments are based on your income and family size, with potential loan forgiveness after 20 or 25 years. Loan forgiveness programs. Various programs exist that can help borrowers reduce or eliminate their student loan debt. Public service loan forgiveness. PSLF available to borrowers who work full-time for qualifying employers in public service fields. After making 120 qualifying monthly payments, the remaining balance may be forgiven. Teacher loan forgiveness. Offers forgiveness for teachers who work in low-income schools for 5 consecutive years. Income-driven repayment forgiveness. If you remain in an income-driven repayment plan for the required number of years, you may have your remaining balance forgiven. Managing your student loans. Here are some tips for managing your student loans effectively. Know your loans. Keep track of the types of loans you have, their interest rates, and your repayment terms. Make payments on time. Set up reminders or automatic payments to avoid missing deadlines and incurring fees. Consider consolidation or refinancing. If you have multiple loans, consolidating them may simplify payments. Refinancing can potentially lower your interest rate, but be cautious as it may result in losing federal protections. Resources for assistance. Several resources are available to help you navigate your student loans. Federal Student Aid website provides comprehensive information on federal loans, repayment options, and forgiveness programs. Loan servicers. Contact your loan servicer for specific questions about your loans and repayment options. Financial advisors. Consider consulting a financial advisor for personalized guidance on managing your student loans and overall financial plan. Understanding credit cards. A credit card is a financial tool that allows you to borrow money up to a certain limit to make purchases or withdraw cash. You are expected to pay back this borrowed amount, typically on a monthly basis, along with any interest that may have accrued. Learning how to effectively manage credit cards is crucial for your financial health, especially as you transition into adulthood after college. How credit cards work. When you use a credit card, you are essentially taking a loan from the credit card issuer. Each month, you receive a statement detailing your purchases, the total amount owed, and the minimum payment required. If you pay off the full balance by the due date, you can avoid interest charges. However, if you only make the minimum payment, interest will accrue on the remaining balance. Types of credit cards. There are several types of credit cards, each designed to meet different financial needs. Standard credit cards. These are basic cards that offer a credit limit and may come with few rewards. Rewards credit cards. These cards offer points, cash back, or travel rewards for every purchase you make. Secured credit cards. These require a cash deposit as collateral and are often used by individuals building or rebuilding their credit history. Student credit cards. Tailored for college students, these cards typically have lower credit limits and may offer rewards for educational expenses. Benefits of using credit cards. Credit cards can be advantageous when used responsibly. Building credit history. Regular, responsible use of a credit card can help establish and improve your credit score. Convenience. Credit cards are widely accepted and can be more convenient than carrying cash. Rewards and perks. Many credit cards offer rewards such as cash back, travel points, and other benefits that can be advantageous. Emergency access to funds. Credit cards can provide a financial cushion in emergencies when cash is not available. Risks of using credit cards. While credit cards offer benefits, they also come with risks that require careful management. Debt accumulation. It is easy to overspend with credit cards, leading to debt that can spiral out of control. High interest rates. If you do not pay your balance in full, interest can accrue rapidly, increasing the total amount owed. Impact on credit score. Late payments or high credit utilization can negatively affect your credit score. Best practices for credit card management. To make the most of your credit card and avoid common pitfalls, consider the following best practices. Pay your balance in full. Always try to pay off your balance in full each month to avoid interest charges. Make payments on time. Set up reminders or automatic payments to ensure you never miss a due date. Monitor your spending. Keep track of your purchases to avoid exceeding your budget and credit limit. Review statements regularly. Regularly check your credit card statements for errors or unauthorized charges. Understanding credit cards is essential for recent graduates looking to establish a strong financial foundation. By learning how credit cards work, recognizing their benefits and risks, and following best practices, you can manage your credit effectively and build a positive financial future. Understanding personal loans. Personal loans are a type of unsecured loan that borrowers can use for a variety of purposes such as consolidating debt, financing a large purchase, or covering unexpected expenses. Unlike secured loans, which require collateral, personal loans are based on the borrower's creditworthiness and ability to repay. Types of personal loans. There are several types of personal loans, including fixed-rate personal loans. These loans have a fixed interest rate and a set repayment term, making monthly payments predictable. Variable rate personal loans. The interest rate on these loans can change over time, which may affect monthly payments. Peer-to-peer loans. These are loans that are funded by individual investors rather than traditional financial institutions. Debt consolidation loans. These loans are used specifically to pay off existing debts, often at a lower interest rate. How to apply for a personal loan. Applying for a personal loan typically involves the following steps. Check your credit score. Before applying, review your credit report and score to understand your creditworthiness. Compare lenders. Research different lenders to find the best interest rates and terms that suit your needs. Gather documentation. Lenders will require documentation such as proof of income, employment verification, and identification. Submit your application. Fill out the application form with accurate information and submit it along with the required documents. Review loan offers. If approved, carefully review the loan terms, including interest rates, fees, and repayment schedules. Factors to consider before taking a personal loan. Before taking out a personal loan, consider the following factors. Interest rates. Compare rates from multiple lenders to ensure you're getting the best deal. Loan terms. Understand the length of the loan and the repayment schedule to avoid financial strain. Fees and charges. Be aware of any origination fees, prepayment penalties, or late payment fees associated with the loan. Your financial situation. Assess your ability to repay the loan without compromising your budget. Potential risks. While personal loans can be beneficial, they also come with risks. Debt accumulation. Taking on too much debt can lead to financial difficulties, especially if income fluctuates. Impact on credit score. Late payments or defaulting on a loan can negatively affect your credit score. High interest rates. Some personal loans may have high interest rates that can increase overall repayment costs. Responsible borrowing practices. To manage personal loans effectively, consider the following tips. Create a budget. Develop a budget to track your income and expenses, ensuring you can make your loan payments on time. Limit borrowing. Only borrow what you need and can afford to repay, avoiding unnecessary debt. Make payments on time. Set up reminders or automatic payments to avoid missed payments and late fees. Communicate with lenders. If you encounter financial difficulties, reach out to your lender to discuss options. Strategies for debt management. Managing debt can be a challenging aspect of personal finance, especially for recent college graduates who may be facing student loans, credit card debt, or other financial obligations. Developing effective strategies for managing debt is crucial for achieving financial stability and building a solid foundation for future financial health. 1. Understand your debt. The first step in effective debt management is to have a clear understanding of your financial obligations. List all your debts, including the following: type of debt, student loans, credit cards, personal loans, etc. Total amount owed, interest rates, minimum monthly payments, due dates. This comprehensive overview will help you prioritize which debts to tackle first and how to allocate your financial resources effectively. 2. Create a budget. Establishing a budget is essential for managing your finances and ensuring that you can meet your debt obligations. Consider the following steps to create an effective budget. Track your income and expenses for a month. Identify fixed and variable expenses. Allocate a portion of your income to debt repayment. Adjust your spending habits to free up more money for debt reduction. By sticking to a budget, you can ensure that you make your debt payments on time and avoid accumulating additional debt. 3. Prioritize your debts. Not all debts are created equal. Some debts carry higher interest rates than others, which can significantly increase the total amount you owe over time. Consider these two popular strategies for prioritizing debt repayment. A. Avalanche method. With the avalanche method, you focus on paying off debts with the highest interest rates first. This can save you money in interest payments over time. Here's how to implement this method. 1. List your debts from highest to lowest interest rate. 2. Make minimum payments on all debts except the one with the highest interest rate. 3. Direct any extra funds toward the debt with the highest interest rate until it is paid off. 4. Move on to the next highest interest rate debt. B. Snowball method. The snowball method involves paying off your smallest debts first, regardless of interest rates. This approach can provide motivational boosts as you eliminate debts. To use this method, 1. List your debts from smallest to largest. 2. Make minimum payments on all debts except the smallest one. 3. Put any extra funds toward the smallest debt until it is paid off. 4. Once the smallest debt is paid, move on to the next smallest debt. From a psychological perspective, this is one of the best strategies to pay off your debt. 4. Explore repayment options. For student loans and other types of debt, explore the various repayment options available to you. Many lenders offer flexible repayment plans that can make managing your debt more manageable. Some options include income-driven repayment plans. Payments are based on your income, making them more affordable. Loan consolidation. Combine multiple loans into one, often with a lower interest rate. Refinancing. Obtain a new loan with better terms to pay off existing debt. 5. Consider professional help. If you feel overwhelmed by your debt situation, consider seeking help from a financial advisor or a credit counseling service. These professionals can provide personalized advice and help you create a sustainable debt management plan. They can also assist with negotiating with creditors or setting up a debt management plan. 6. Stay committed and monitor progress. Debt management is an ongoing process that requires dedication and commitment. Regularly review your budget and debt repayment progress. Celebrate small victories along the way to keep yourself motivated. Adjust your strategies as needed based on changes in your financial situation. By implementing these strategies, you can take control of your debt and work towards a more secure financial future. Remember that the journey to financial freedom takes time, but with persistence, you can achieve your goals. Avalanche method, a strategy for paying off debt. The avalanche method is a highly effective strategy for managing and paying off debt. It focuses on tackling high-interest debts first, thereby minimizing the overall interest paid over time. This approach is particularly beneficial for recent college graduates who may be entering the workforce with student loans, credit card debt, or other financial obligations. How the avalanche method works. To implement the avalanche method, follow these steps. List your debts. Write down all of your debts, including credit cards, loans, and any other financial obligations. Make sure to include the total balance and the interest rate for each debt. Prioritize by interest rate. Organize your debts from the highest interest rate to the lowest. This list will guide your payment strategy. Make minimum payments. For all debts except the one with the highest interest rate, make only the minimum payments. This ensures you stay current on all accounts. Focus extra payments on the highest interest debt. Allocate any extra funds you have each month to the debt with the highest interest rate. This accelerates the payoff of that debt. Repeat the process. Once the highest interest debt is paid off, move to the next debt on your list and repeat the process. Continue until all debts are paid off. Benefits of the avalanche method. Less interest paid. By focusing on high-interest debts first, you reduce the total amount of interest paid over time, saving you money in the long run. Faster debt repayment. Paying off higher interest debts quickly can free up more money for additional payments on lower interest debts. Improved credit score. Reducing your overall debt load can positively impact your credit score, making it easier to secure loans or credit in the future. Example of the avalanche method. Consider the following example. Credit card A. $2,000 balance at 18% interest. Credit card B. $1,500 balance at 12% interest. Student loan. $5,000 balance at 6% interest. In this case, you would first focus on paying off credit card A, as it has the highest interest rate. If you can allocate an extra $300 each month towards this card while making minimum payments on the others, you will pay it off faster and save on interest. Considerations. While the avalanche method is effective, it requires discipline and commitment. Here are some considerations to keep in mind. Emotional factors. Some individuals may prefer the snowball method, which emphasizes paying off smaller debts first for psychological wins. Budgeting. Ensure you have a clear budget to identify how much extra you can allocate towards debt each month. Financial goals. Consider your overall financial goals when implementing the avalanche method. It may take time before you see significant results. By understanding and applying the avalanche method, recent graduates can take control of their finances, reduce their debt burden, and pave the way for a more secure financial future. Consolidation and refinancing options. Managing student loans and other debts can be a challenging task for recent college graduates. Understanding consolidation and refinancing options is crucial for taking control of your financial future. These strategies can help simplify payments and potentially reduce interest rates, making debt management more manageable. Consolidation. Loan consolidation involves combining multiple loans into a single loan. This can be particularly beneficial for graduates with various types of student loans, credit card debts, or personal loans. Here are a few key points to consider. Simplified payments. By consolidating your loans, you will only have to make one monthly payment instead of multiple payments to different lenders. Fixed interest rates. Most consolidation loans offer a fixed interest rate, which can provide stability in your monthly budget. Loan types. There are different types of consolidation options available, including federal student loan consolidation and private loan consolidation. Federal student loan consolidation. Federal student loans can be consolidated through a direct consolidation loan. This program allows you to combine multiple federal loans into one, making it easier to manage. The interest rate for a direct consolidation loan is the weighted average of your existing loans, rounded up to the nearest 1/8%. Private loan consolidation. Private loan consolidation involves combining private loans into a new private loan. This may result in a different interest rate based on your credit score and financial history. It's important to shop around and compare offers from different lenders to find the best terms. Refinancing. Refinancing is another option that allows you to replace your existing loans with a new loan, ideally at a lower interest rate. Here are some benefits and considerations. Potentially lower interest rates. If your credit score has improved since you took out your loans, you might qualify for a lower interest rate, which can save you money over time. Flexible terms. Refinancing allows you to choose new loan terms, such as a shorter or longer repayment period, depending on your financial goals. Eligibility. Unlike consolidation, refinancing can apply to both federal and private loans, but be cautious as refinancing federal loans with a private lender means losing federal protections and benefits. Steps to refinance. Assess your financial situation. Review your credit score, existing debts, and monthly budget to determine if refinancing makes sense. Research lenders. Look for lenders that offer competitive rates and favorable terms. Pay attention to fees and the loan process. Apply for refinancing. Submit your application with the necessary documentation, such as income verification and loan information. Review terms. Carefully read the loan agreement, understanding the new interest rate, monthly payments, and any potential fees. Finalize the loan. Once you are satisfied with the terms, finalize the loan and start making payments as per the new agreement. Considerations before consolidation or refinancing. While consolidation and refinancing can provide relief, it's essential to consider the following. Impact on credit score. Both options can affect your credit score. Consolidation may have a temporary negative impact, while refinancing could improve your score if it reduces your overall debt load. Loan benefits. Federal loans come with specific benefits, such as income-driven repayment plans and loan forgiveness options, which may be lost through refinancing. Long-term financial goals. Ensure that any decision you make aligns with your overall financial strategy and goals for the future. By understanding consolidation and refinancing options, recent graduates can take proactive steps in managing their personal finances effectively. Make informed decisions that align with your financial goals and lead to a more secure financial future. Avoiding debt pitfalls. As recent college graduates, navigating the world of personal finance can be daunting, especially when it comes to managing debt. Understanding how to avoid common debt pitfalls is essential for building a stable financial future. Understanding debt types. Before you can avoid debt pitfalls, it's crucial to understand the different types of debt. Student loans, often the first form of debt for many graduates. They can be federal or private, each with different repayment terms and interest rates. Credit card debt, high-interest debt that can accumulate quickly if not managed properly. It's essential to use credit cards wisely and pay off balances each month. Personal loans. These loans can be used for various purposes, but often come with high interest rates. Use them sparingly and only when necessary. Auto loans. Financing a vehicle can be manageable if you budget correctly, but be wary of taking on more than you can afford. Creating a budget. A well-structured budget is your first line of defense against accumulating unnecessary debt. Here's how to create one. Track your income. Document all sources of income, including your salary and any side gigs. List your expenses. Break down your monthly expenses into fixed, rent, utilities, and variable categories, entertainment, dining out. Set spending limits. Allocate a specific amount for each category and stick to it. Review regularly. Assess your budget every month and make adjustments as necessary. Avoiding high-interest debt. One of the biggest pitfalls is falling into the trap of high-interest debt. Here are some strategies to avoid it. Pay off credit card balances. Always aim to pay off your balance in full to avoid accruing interest. Shop for loans. Compare interest rates and terms from different lenders before committing. Consider credit unions. They often offer lower interest rates on loans compared to traditional banks. Building an emergency fund. An emergency fund is crucial for avoiding debt pitfalls. It acts as a financial safety net, ensuring that unexpected expenses don't lead you to rely on credit. Aim for 3 to 6 months of expenses. Save enough to cover your essential expenses for several months. Automate savings. Set up automatic transfers to your savings account to build your fund consistently. Educating yourself. Continual education about financial management can help you avoid debt pitfalls. Take financial literacy courses. Many online platforms offer free or low-cost courses on personal finance. Follow financial blogs and podcasts. Stay informed about best practices and financial news. Seeking professional advice. If you find yourself struggling with debt, consider consulting a financial advisor. They can provide tailored advice and strategies to help you regain control of your finances. By understanding the types of debt, creating a budget, avoiding high-interest loans, building an emergency fund, educating yourself, and seeking professional advice, you can effectively navigate your post-college financial landscape and steer clear of common debt pitfalls. Understanding interest rates. Interest rates play a crucial role in personal finance and can significantly impact your financial decisions. Whether you're taking out a loan, investing, or saving money, understanding how interest rates work is essential for managing your finances effectively. What is an interest rate? An interest rate is the cost of borrowing money or the return on investment for saving or investing money. It is usually expressed as a percentage of the principal amount, the initial amount of money borrowed or invested over a specific period. Types of interest rates. Fixed interest rate. This type of interest rate remains constant throughout the life of the loan or investment. It provides stability and predictability, making it easier to plan your finances. Variable or adjustable interest rate. In contrast, a variable interest rate can change over time, often in relation to a benchmark rate. This can lead to fluctuations in your payments, making it more challenging to budget. How interest rates affect borrowing. When you take out a loan, the interest rate determines how much you'll pay in addition to the principal. A higher interest rate means higher monthly payments and more money paid over the life of the loan. For example, consider a student loan, car loan, or mortgage. Each of these loans may have different interest rates based on various factors like credit score, loan type, and lender policies. How interest rates affect saving and investing. When saving or investing money, interest rates can influence the returns you receive. Savings accounts, certificates of deposit, CDs, and bonds typically offer interest on your deposits or investments. Higher interest rates can lead to increased earnings on your savings, while lower rates may result in minimal returns. Understanding the impact of inflation. Interest rates are also closely tied to inflation. Inflation represents the increase in prices over time, which can erode the purchasing power of your money. Central banks, like the Federal Reserve in the United States, often adjust interest rates to control inflation. When inflation rises, central banks may increase interest rates to encourage saving and reduce spending, while lowering rates during periods of low inflation to stimulate economic growth. Calculating interest. To understand how much interest you will pay or earn, you can use the following formulas. Simple interest. Interest equals principal x rate x time compound interest. A equals P, 1 plus or slash n caret and T, where A is the amount of money accumulated after n years, including interest. P is the principal amount, the initial amount of money. Risk the annual interest rate decimal. NIS the number of times that interest is compounded per year. 'Tis the number of years the money is invested or borrowed. Factors influencing interest rates. Several factors can influence interest rates, including credit score. Lenders use your credit score to assess the risk of lending to you. A higher credit score can result in lower interest rates. Economic conditions. During periods of economic growth, interest rates may rise, while they may fall during economic downturns. Central bank policies. Central banks set benchmark interest rates that influence borrowing costs throughout the economy, making informed financial decisions. Understanding interest rates is vital for making informed financial decisions. Whether you are borrowing money, saving for future goals, or investing, being aware of how interest rates work will help you manage your money more effectively and achieve your financial objectives. Building a good credit score. Establishing a good credit score is crucial for recent college graduates as it can impact various aspects of financial life, including loan approval, interest rates, and rental applications. Understanding how credit scores work and the steps to build and maintain a good score can empower individuals to make informed financial decisions. What is a credit score? A credit score is a numerical representation of a person's creditworthiness, typically ranging from 300 to 850. Lenders use this score to evaluate the risk of lending money or extending credit. The higher the score, the more favorable the terms of credit will likely be. Factors that affect your credit score. Payment history. 35% timely payments on credit accounts are the most significant factor influencing your credit score. Late payments can have a detrimental effect. Credit utilization. 30%. This ratio measures how much of your available credit you are using. Keeping your utilization below 30% is generally recommended. Length of credit history. 15%. The longer your credit history, the better it is for your score. This includes how long your accounts have been open. Types of credit. 10%. Having a mix of credit types, such as credit cards, student loans, and auto loans, can positively impact your score. New credit. 10%. Opening multiple new accounts in a short period can lower your score. Each new application can result in a hard inquiry on your credit report. Steps to build a good credit score. 1. Start with a credit card. For recent graduates, obtaining a credit card is often the first step to building credit. Consider applying for a secured credit card if you have no credit history. These require a cash deposit, which acts as your credit limit. 2. Make payments on time. Consistently paying your bills on time is critical. Set up reminders or automatic payments to ensure you never miss a due date. 3. Keep credit utilization low. Try to use less than 30% of your total available credit. If possible, pay off your balance in full each month to avoid interest charges. 4. Monitor your credit report. Regularly checking your credit report can help you identify any errors or fraudulent activity. You can obtain a free credit report from each of the 3 major credit bureaus once a year at annualcreditreport.com. 5. Avoid opening too many accounts at once. While it may be tempting to sign up for multiple credit cards to increase your available credit, doing so can lower your score. Space out your applications over time. 6. Be patient. Building a good credit score takes time. Consistency in managing your finances will lead to gradual improvement in your creditworthiness. Understanding credit reports. Your credit report provides a detailed account of your credit history. It includes information about your credit accounts, payment history, and any public records like bankruptcies. Review your report for accuracy and dispute any errors you find. Establishing and maintaining a good credit score is an essential skill for personal financial management. By understanding the factors that influence your score and taking proactive steps to build it, you can saving and investing the importance of saving. Saving money is a fundamental aspect of financial literacy and personal finance management. For recent college graduates, understanding the importance of saving can set the foundation for a secure financial future. Here are several key reasons why saving is essential. Building an emergency fund. Life is unpredictable, and having an emergency fund can provide financial security in times of need. An emergency fund typically covers 3 to 6 months' worth of living expenses. This fund can help you navigate unexpected situations such as job loss, medical emergencies, or urgent home repairs without falling into debt. Achieving financial goals. Many graduates have goals that require financial resources, whether it's traveling, buying a car, or saving for a home. By consistently saving money, you can work towards these goals more effectively. Setting aside a portion of your income each month helps you accumulate the necessary funds over time. Reducing financial stress. Financial stress can take a toll on your mental and emotional well-being. Knowing that you have savings to fall back on can ease anxiety related to money management. It allows you to make more informed financial decisions without the pressure of living paycheck to paycheck. Preparing for retirement. Although retirement may seem far off for recent graduates, starting to save early can significantly impact your financial health later in life. The power of compound interest means that the sooner you begin saving, the more your money can grow over time. Contributing to retirement accounts such as a 401k or an IRA can set you on the path to a comfortable retirement. Gaining financial independence. Saving money empowers you to make choices that align with your personal values and aspirations. With sufficient savings, you can pursue career opportunities that may not offer the highest salary but align with your passions. Financial independence provides the freedom to take calculated risks and make life choices based on your goals. Understanding financial responsibility. Learning to save is an essential component of financial responsibility. It teaches discipline and planning, helping you to prioritize your spending and make informed financial decisions. Developing strong saving habits early on can lead to a lifetime of financial wellness. Creating wealth. Saving is the first step toward investing and building wealth. When you save money, you can explore investment opportunities that can grow your wealth over time. Understanding the difference between saving and investing is crucial, as both play important roles in financial management. In summary, saving is not just about setting aside money. It's about cultivating a mindset that values financial security and growth. As a recent graduate, embracing the importance of saving can lead to a more stable and prosperous financial future. Understanding emergency funds. An emergency fund is a crucial component of financial security. It serves as a financial safety net for unexpected expenses, such as medical emergencies, car repairs, or sudden job loss. Creating an emergency fund can help alleviate stress and provide a sense of stability in unpredictable situations. Why you need an emergency fund. Having an emergency fund is essential for several reasons. Financial security. An emergency fund provides a buffer against unforeseen expenses, allowing you to handle emergencies without relying on credit cards or loans. Peace of mind. Knowing that you have savings set aside for emergencies can reduce anxiety and give you confidence in your financial decision-making. Debt prevention. An emergency fund can help you avoid falling into debt when unexpected costs arise, as you will have the funds readily available to cover them. How much should your emergency fund be? The size of your emergency fund can vary depending on individual circumstances. A common recommendation is to save 3 to 6 months' worth of living expenses. To determine this amount, consider the following. Calculate your monthly expenses, including rent, utilities, groceries, transportation, and any other necessary costs. Multiply your total monthly expenses by the desired number of months, 3 to 6, to establish your target emergency fund amount. Steps to create your emergency fund. Set a savings goal. Based on your calculations, set a specific savings goal for your emergency fund. Choose a savings account. Select a high-yield savings account to keep your emergency fund separate from your regular checking account. This will help you avoid the temptation to spend from it. Automate your savings. Set up automatic transfers from your checking account to your emergency fund each month. This ensures consistent contributions without needing to think about it. Start small. If saving a large amount seems overwhelming, start with a smaller goal, such as $500 or $1,000, and gradually increase it over time. Review and adjust. Periodically assess your emergency fund to ensure it meets your current needs and adjust your savings contributions as necessary. Where to keep your emergency fund? It's important to keep your emergency fund in a place where it is easily accessible, but not too easy to dip into for non-emergencies. Here are a few options. High-interest savings account. A high-yield savings account offers better interest rates than traditional savings accounts while keeping your money liquid. Money market account. Similar to a savings account, a money market account often has higher interest rates and may allow for limited check-writing capabilities. Certificate of deposit. CD. While CDs typically offer higher interest rates, they require you to lock in your money for a set period. This may not be ideal for an emergency fund that needs to remain liquid. When to use your emergency fund? Use your emergency fund only for genuine emergencies. Examples include unexpected medical expenses not covered by insurance, car repairs that are essential for transportation, job loss, or reduced income that affects your ability to pay bills, major home repairs that cannot be postponed. By establishing and maintaining an emergency fund, you will be better prepared to handle life's unexpected challenges while protecting your financial well-being. Understanding long-term savings goals. Long-term savings goals are essential for achieving financial stability and security. These goals typically extend beyond 5 years and can include objectives such as purchasing a home, funding children's education, or preparing for retirement. Establishing clear long-term savings goals helps individuals prioritize their financial decisions and create effective saving strategies. Importance of long-term savings. Saving for the long term allows you to take advantage of compound interest, which can significantly increase your wealth over time. The earlier you start saving, the more time your money has to grow. Long-term savings can also provide a safety net against unexpected expenses, ensuring that you are financially prepared for the future. Setting long-term savings goals. To set effective long-term savings goals, follow these steps. Identify your goals. Determine what you are saving for. Common long-term goals include retirement, buying a home, or funding education. Set a timeline. Decide when you would like to achieve these goals. This will help you determine how much you need to save each month. Determine the amount needed. Research the costs associated with your goals. For instance, estimate how much you will need for a down payment on a house or the total cost of education. Choose the right savings vehicle. Different goals may require different savings methods. Consider using high-yield savings accounts, certificates of deposit, CDs, or investment accounts based on your timeline and risk tolerance. Strategies for achieving long-term savings goals. Once you have defined your long-term savings goals, consider the following strategies. Automate your savings. Set up automatic transfers from your checking account to your savings account or investment account. This makes saving easier and ensures consistency. Adjust your budget. Review your monthly expenses and identify areas where you can cut back. Redirect these funds toward your savings goals. Increase your income. Explore side hustles or additional work opportunities to boost your income. Use the extra earnings to fund your long-term savings. Monitor your progress. Regularly review your savings goals and assess your progress. Adjust your strategies as needed to stay on track. Common long-term savings goals. Here are some common long-term savings goals to consider. Retirement savings. Aim to save a percentage of your income in retirement accounts, such as a 401k or IRA. Home purchase. Save for a down payment, which can range from 3% to 20% of the home's price. Education fund. Establish a dedicated fund for your children's education, such as a 529 plan. Emergency fund. Build a savings cushion that can cover 3 to 6 months of expenses for unexpected situations. Setting and working towards long-term savings goals is a critical aspect of financial health. By understanding the importance of these goals and developing a structured approach to saving, you can achieve financial independence and security in the years to come. Introduction to investing. Investing is a crucial component of building wealth and achieving financial security. For recent college graduates, understanding the basics of investing can set the foundation for a prosperous financial future. This section will cover the fundamental concepts of investing, the different types of investments, and the importance of developing an investment strategy. What is investing? Investing involves allocating resources, typically money, with the expectation of generating an income or profit. Unlike saving, which involves putting money aside for future use, investing is about making your money work for you over the long term. This can include purchasing assets that are expected to increase in value or generate income. The importance of investing. Investing is essential for several reasons. Wealth accumulation. Investing allows your money to grow over time, outpacing inflation and increasing your purchasing power. Retirement savings. Early investing is vital for building a substantial retirement fund, especially with the power of compound interest. Financial goals. Investing helps you achieve various financial goals, such as buying a home, funding education, or starting a business. Types of investments. There are several types of investments to consider, each with its own level of risk and potential return. Stocks. Stocks represent ownership in a company. When you buy a stock, you purchase a share of that company. Stocks can provide high returns, but they also come with higher risk due to market volatility. Bonds. Bonds are debt securities issued by corporations or governments. When you buy a bond, you are lending money in exchange for periodic interest payments and the return of the bond's face value at maturity. Bonds are generally considered safer than stocks, but offer lower returns. Mutual funds. Mutual funds pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. They are managed by professional fund managers and offer an easy way to diversify investments. Exchange-traded funds, ETFs. ETFs are similar to mutual funds, but trade on stock exchanges like individual stocks. They typically have lower fees and offer diversification across various asset classes. Real estate. Real estate investing involves purchasing property to generate rental income or sell for a profit. This can be a tangible investment, but requires significant capital and ongoing management. Developing an investment strategy. Creating a successful investment strategy is essential for achieving your financial goals. Here are some key steps to consider. Define your goals. Identify your short-term and long-term financial goals. Are you saving for a house, retirement, or education? Understanding your objectives will guide your investment choices. Assess your risk tolerance. Evaluate how much risk you are willing to take. This will depend on your financial situation, investment timeline, and personal comfort with market fluctuations. Diversify your portfolio. Diversification involves spreading your investments across various asset classes to reduce risk. A well-diversified portfolio can help protect your investments from market volatility. Regularly review and adjust. Your investment strategy should be a living document. Regularly review your portfolio and make adjustments based on market conditions, life changes, or shifts in your financial goals. Understanding the basics of investing is crucial for recent college graduates looking to manage their personal finances effectively. By learning about different types of investments and developing a solid investment strategy, you can take significant steps towards achieving your financial goals. Basic investment vehicles. Stocks. Stocks represent ownership in a company. When you buy a stock, you are purchasing a small piece of that company, known as a share. Stocks are typically classified into two categories, common stocks and preferred stocks. Common stocks give shareholders voting rights in company decisions, while preferred stocks usually do not come with voting rights but have a higher claim on assets and earnings. The primary benefit of investing in stocks is the potential for high returns, as they can appreciate significantly over time. However, stocks are also subject to market volatility, meaning their prices can fluctuate widely. Bonds. Bonds are debt securities issued by corporations, municipalities, or governments to raise capital. When you purchase a bond, you are essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value at maturity. Bonds are typically considered a more stable investment compared to stocks. There are several types of bonds, including corporate bonds, issued by companies to finance operations; municipal bonds, issued by states or local governments, often tax-exempt; treasury bonds, issued by the federal government, considered one of the safest investments. Bonds tend to provide lower returns than stocks, but are generally less risky, making them a suitable option for conservative investors or those looking for steady income. Mutual funds. Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. A professional fund manager manages the mutual fund, making decisions about which securities to buy and sell. Investing in mutual funds offers several advantages: Diversification. By investing in a mutual fund, you gain exposure to a variety of assets, which can help reduce risk. Professional management. Fund managers have expertise in selecting investments, which can be beneficial for those who may not have the time or knowledge to manage their portfolios. Liquidity. Mutual funds can be bought and sold on any business day at the current net asset value, NAV. However, mutual funds may come with management fees and expenses, which can impact overall returns. It's essential to understand the fund's objectives, fees, and performance history before investing. Understanding risk tolerance. Risk tolerance refers to the degree of variability in investment returns that an individual is willing to withstand in their investment portfolio. It is a crucial concept in personal finance, especially for recent college graduates who may be new to investing. Understanding your risk tolerance helps in selecting the right investment strategy and asset allocation that aligns with your financial goals. Factors influencing risk tolerance. Time horizon. The length of time you expect to hold an investment before needing the funds can significantly affect your risk tolerance. Generally, the longer your time horizon, the more risk you can afford to take. Financial situation. Your current financial situation, including income, savings, and expenses, can impact your ability to take on risk. Those with a stable income may be more comfortable with higher risk investments. Investment knowledge. Familiarity with investment concepts can influence your confidence in taking risks. More knowledgeable investors may feel comfortable with volatility. Emotional comfort. Individual emotional responses to market fluctuations can also dictate risk tolerance. Some people are naturally more conservative, while others may thrive on the excitement of high-risk investments. Asset allocation. Asset allocation is the process of dividing an investment portfolio among different asset categories, such as stocks, bonds, and cash. This strategy is designed to manage risk and optimize returns based on an individual's risk tolerance, investment goals, and time horizon. Types of asset classes. Equities. Stocks represent ownership in a company and provide potential for high returns, but come with higher risk and volatility. Bonds. Debt instruments that pay interest over time and are generally considered safer than stocks, providing lower returns. Cash and cash equivalents. Include savings accounts and money market funds. These are low risk, but typically offer the lowest returns. Real estate. Investing in property can provide rental income and capital appreciation, but requires significant capital and management. Importance of diversification. Diversification is a key principle of asset allocation. By spreading investments across various asset classes, sectors, and geographical regions, you can reduce the overall risk of your portfolio. A well-diversified portfolio can help mitigate the impact of a poor-performing investment, as gains in other areas may offset losses. Determining your asset allocation. To determine your optimal asset allocation, you should consider the following steps. Assess your risk tolerance using questionnaires or personal reflection. Define your financial goals, such as retirement, buying a home, or funding education. Evaluate your time horizon for each goal, as longer time frames allow for more aggressive allocations. Choose a mix of asset classes that align with your risk tolerance and investment objectives. Regularly review and adjust your asset allocation as your financial situation and goals evolve. Monitoring and rebalancing. Once you have established your asset allocation, it's essential to monitor your investments regularly. Market fluctuations can cause your asset allocation to drift from your target percentages. Rebalancing involves buying or selling assets to restore your desired allocation, helping maintain your risk level and investment strategy. Understanding retirement planning. Retirement planning is an essential aspect of personal finance that involves preparing for financial stability and security in your later years. As a recent college graduate, it might seem premature to think about retirement, but starting early can significantly impact your financial future. Why start early? The sooner you start planning for retirement, the more time your money has to grow. This is largely due to the power of compound interest, where the returns on your investments generate additional earnings over time. Even small contributions made early in your career can accumulate into a substantial retirement fund. Setting retirement goals. Before you can effectively plan for retirement, it's important to define your retirement goals. Consider the following questions. At what age do you want to retire? What lifestyle do you envision during retirement? What are your anticipated expenses during retirement? Types of retirement accounts. There are several types of retirement accounts that you can utilize to save for your future. Understanding these options will help you make informed decisions. 1. 401k plans. A 401k plan is an employer-sponsored retirement account that allows you to save a portion of your paycheck before taxes are taken out. Many employers offer matching contributions, which is essentially free money that can significantly boost your savings. 2. Traditional IRA. A traditional individual retirement account, IRA, allows you to contribute pre-tax dollars, potentially lowering your taxable income. However, you'll pay taxes on withdrawals during retirement. 3. Roth IRA. A Roth IRA is funded with after-tax dollars, meaning you won't pay taxes on withdrawals in retirement. This option is particularly beneficial if you expect to be in a higher tax bracket when you retire. Creating a retirement savings plan. To create an effective retirement savings plan, follow these steps. 1. Determine how much to save. A common recommendation is to save at least 15% of your income for retirement. If that's not feasible initially, start with a smaller percentage and gradually increase it. 2. Automate your savings. Set up automatic contributions to your retirement accounts. Automating your savings makes it easier to stay consistent and ensures that you prioritize retirement savings. 3. Review and adjust your plan. Regularly review your retirement plan and make adjustments as necessary. Life changes, such as a new job, marriage, or children, can impact your retirement goals and savings strategies. Investment strategies. Investing is a crucial component of retirement planning, as it can help grow your savings over time. Here are some investment strategies to consider. 1. Diversification. Spread your investments across different asset classes, such as stocks, bonds, and real estate. Diversification helps manage risk and can lead to more stable returns. 2. Risk tolerance. Assess your risk tolerance when choosing investments. Generally, younger investors can afford to take more risks, as they have time to recover from market downturns. 3. Rebalance your portfolio. As you approach retirement, adjust your investment strategy to become more conservative. This might involve shifting a portion of your investments from stocks to bonds to reduce risk. The importance of professional guidance. If you're unsure about how to navigate retirement planning, consider seeking the advice of a financial advisor. They can provide personalized guidance and help you create a tailored retirement strategy that aligns with your goals and financial situation. Retirement planning is an ongoing process that requires attention and adjustments over time. By starting early, setting clear goals, and utilizing the right accounts and investment strategies, you can build a secure financial future for your retirement years. Understanding retirement accounts. As recent college graduates, it is essential to understand the different types of retirement accounts available to you. 2 of the most common accounts are the 401k and the individual retirement account, IRA. Each serves a unique purpose and offers various benefits that can help you secure your financial future. 401k plans. A 401k plan is an employer-sponsored retirement savings account that allows employees to save and invest a portion of their paycheck before taxes are taken out. Here are some key features. Tax advantages. Contributions to a traditional 401k are made pre-tax, which means they reduce your taxable income for the year. Taxes on both contributions and earnings are deferred until withdrawal during retirement. Employer match. Many employers offer a matching contribution where they will match a certain percentage of your contributions. This essentially gives you free money for your retirement. Contribution limits. The IRS sets annual contribution limits. For 2023, the limit is $22,500 for individuals under 50 years old. Those aged 50 and over can contribute an additional $7,500 as a catch-up contribution. Investment options. 401k. Plans typically offer a range of investment options, including mutual funds, stocks, and bonds. It is important to review these options and choose investments that align with your risk tolerance and retirement goals. Individual retirement accounts, IRA. An IRA is a personal retirement savings account that offers tax advantages for retirement savings. There are 2 primary types of IRAs, traditional IRAs and Roth IRAs. Traditional IRA. Tax deductibility. Contributions to a traditional IRA may be tax deductible, depending on your income and whether you have access to a workplace retirement plan. Like a 401k, taxes are deferred until withdrawal. Contribution limits. For 2023, the contribution limit for a traditional IRA is $6,500, with an additional $1,000 catch-up contribution allowed for those aged 50 and older. Withdrawal rules. Withdrawals made before age 59 and a half are typically subject to a 10% penalty, along with income tax, unless certain conditions are met. Roth IRA. Tax-free growth. Contributions to a Roth IRA are made with after-tax dollars, meaning you pay taxes on the contributions up front. However, qualified withdrawals during retirement are tax-free. Income limits. Roth IRAs have income eligibility limits. For 2023, single filers with a modified adjusted gross income, MAGI, over $138,000 are ineligible to contribute directly. Flexible withdrawals. Unlike traditional IRAs, contributions to a Roth IRA can be withdrawn at any time without penalty, making it a flexible option for those who may need access to funds before retirement. Choosing the right account. Deciding between a 401k and an IRA, or using both, depends on your financial situation, employment benefits, and retirement goals. Here are some considerations. If your employer offers a 401k with a matching contribution, consider contributing enough to get the full match before contributing to an IRA. If you're self-employed or your employer doesn't offer a retirement plan, an IRA may be a better option. Evaluate your current and expected future tax situation to determine which account type may be more beneficial. Understanding retirement accounts is a vital step in managing your finances effectively. By taking the time to learn about these accounts and how they work, you can make informed decisions that will help you build a secure financial future. Starting early and compound interest. When it comes to personal finance, one of the most powerful concepts you can leverage is compound interest. Understanding how it works and the benefits of starting early can significantly impact your financial future. What is compound interest? Compound interest is the interest calculated on the initial principal, which also includes all the accumulated interest from previous periods. This means that, over time, your money can grow at an accelerating rate. The formula for calculating compound interest is A equals P, 1 plus or slash N caret NT, where A equals the amount of money accumulated after N years, including interest. P equals the principal amount, the initial sum of money. R equals annual interest rate, decimal. N equals number of times that interest is compounded per year. T equals the number of years the money is invested or borrowed. The benefits of starting early. One of the key advantages of starting to save and invest early is that it allows you to take full advantage of compound interest. Here are some reasons why starting early is beneficial. Time is on your side. The earlier you start saving, the longer your money has to grow. Even small contributions can accumulate significantly over time. Less pressure to save large amounts. By starting early, you can make smaller contributions over a longer period, making it easier to reach your financial goals without feeling overwhelmed. Increased financial security. Early investments can lead to a more secure financial future, allowing you to build wealth and achieve your life goals. Example of compound interest in action. Consider a simple example to illustrate how compound interest works. If you invest $1,000 at an annual interest rate of 5%, compounded annually, after 30 years you would have A equals 1,000, 1 plus 0.05 slash 1, caret, 1 by 30, equals 1,000, 1.05. Caret 30 is almost equal to $4,321.94 if you wait 10 years to start investing the same amount. After 20 years you would have A equals 1,000, 1 plus 0.05 slash 1, caret, 1 by 20, equals 1,000, 1.05. Caret 20 is almost equal to $2,653.30. This example highlights the difference that starting early can make. The earlier you begin saving and investing, the more you can benefit from the effects of compound interest. Strategies for starting early. To maximize the benefits of compound interest, consider implementing the following strategies. Create a budget. Establish a budget that allows you to allocate funds towards savings and investments regularly. Set up automatic contributions. Automate your savings by setting up direct deposits into your savings or investment accounts. Take advantage of employer match. If your employer offers a retirement plan with matching contributions, Make sure to contribute enough to take full advantage of this benefit. Educate yourself. Understanding insurance. The different types of insurance. Insurance is a critical component of financial management, offering protection against unforeseen risks and financial losses. Understanding the various types of insurance available can help recent college graduates make informed decisions about their financial futures. Health insurance. Health insurance covers medical expenses incurred due to illnesses, injuries, and other health-related issues. It can help pay for doctor visits, hospital stays, medications, and preventive care. There are several types of health insurance plans, including employer-sponsored plans. Many employers offer health insurance as part of their benefits package. Individual plans. Graduates can purchase their own health insurance policies directly from insurance companies or through health insurance marketplaces. Government programs. Programs like Medicaid and Medicare provide coverage for eligible individuals. Auto insurance. Auto insurance protects against financial losses related to vehicle ownership. It covers damages to your vehicle, injuries sustained by you or others in an accident, and theft. Types of auto insurance include liability coverage. Covers damages and injuries you cause to others in an accident. Collision coverage. Pays for damage to your own vehicle after an accident, regardless of who is at fault. Comprehensive coverage. Covers non-collision related incidents, such as theft or natural disasters. Renter's insurance. Renter's insurance is designed for individuals renting a home or apartment. It covers personal property against theft, fire, and other damages, as well as liability protection if someone is injured in your rented space. This type of insurance is often affordable and provides significant peace of mind. Homeowner's insurance. Homeowner's insurance is essential for those who own a home. It protects the structure of the house and personal belongings against various risks, including fire, theft, and natural disasters. Homeowner's insurance typically includes dwelling coverage, covers the physical structure of your home. Personal property coverage, protects your belongings inside the home. Liability coverage, offers protection in case someone is injured on your property. Life insurance. Life insurance provides financial protection to beneficiaries in the event of the policyholder's death. It can help cover living expenses, debts, and funeral costs. The main types of life insurance include term life insurance, provides coverage for a specified period, usually 10 to 30 years. Whole life insurance, offers lifelong coverage and includes a cash value component that grows over time. Universal life insurance, a flexible policy that combines life coverage with a cash value component, allowing for adjustments in premiums and coverage amounts. Disability insurance. Disability insurance protects your income in case you become unable to work due to illness or injury. It typically provides a percentage of your salary for a specified period. There are two main types. Short-term disability insurance offers coverage for a limited time, usually a few months after an injury or illness. Long-term disability insurance provides coverage for an extended period, often until retirement age. Travel insurance. Travel insurance covers various risks associated with traveling, such as trip cancellations, lost luggage, medical emergencies, and travel delays. It is particularly useful for those planning trips abroad or expensive vacations. Umbrella insurance. Umbrella insurance offers additional liability coverage beyond the limits of your other insurance policies, such as auto or homeowner's insurance. It provides an extra layer of protection in the event of a lawsuit or significant claims that exceed your standard policy limits. Understanding health insurance. Health insurance is a vital component of financial planning, especially for recent college graduates who may be entering the workforce and navigating new responsibilities. It helps cover the costs of medical care, providing a safety net in case of unexpected health issues. Types of health insurance. There are several types of health insurance plans available. Employer-sponsored insurance. Many employers offer health insurance as part of their employee benefits package. This option often includes a variety of plans and may cover a significant portion of the premium. Individual health insurance. If you are self-employed or your employer does not offer insurance, you can purchase an individual plan through the health insurance marketplace or directly from insurance companies. Government programs. Programs such as Medicaid and Medicare provide health coverage for eligible individuals. Medicaid assists low-income individuals, while Medicare is primarily for those aged 65 and older. Key terms to know. When navigating health insurance, it's essential to understand some key terms. Premium, the amount you pay for your health insurance every month, regardless of whether you use medical services. Deductible, the amount you must pay out of pocket before your insurance begins to pay for covered services. Copayment, a fixed amount you pay for a specific service, such as a doctor's visit or prescription medication, after reaching your deductible. Out-of-pocket maximum, the maximum amount you will pay for covered services in a plan year. After reaching this limit, the insurance company pays 100% of covered costs. Choosing a health insurance plan. When selecting a health insurance plan, consider the following factors. Coverage needs. Assess your health needs and those of your family. Consider any ongoing medical conditions and the frequency of doctor visits. Network of providers. Ensure your preferred doctors and hospitals are included in the plan's network to avoid higher out-of-pocket costs. Costs. Compare premiums, deductibles, and out-of-pocket maximums to find a plan that fits your budget. Additional benefits. Some plans offer extra services like mental health support, wellness programs, or telehealth options. Enrollment periods. Health insurance plans typically have specific enrollment periods. Open enrollment, a designated time each year when you can enroll in or change your health insurance plan. Special enrollment period. You may qualify for a special enrollment period due to life events such as moving, getting married, or losing other health coverage. Understanding the importance of health insurance. Having health insurance is crucial for managing your personal finances. It can prevent significant medical expenses from derailing your financial stability. Unexpected medical emergencies can lead to hefty bills, and without insurance, you may face financial hardship. By understanding health insurance, its components, and how to choose the right plan, you can make informed decisions that protect your health and your finances as you transition into post-college life. Understanding auto insurance. Auto insurance is a crucial component of financial planning for recent college graduates, especially for those who own or plan to purchase a vehicle. It provides financial protection in the event of accidents, theft, or damage to your car, as well as coverage for liability in case you cause an accident that injures someone else or damages their property. Types of auto insurance coverage. There are several types of coverage options available, each serving different purposes. Liability coverage. This is the most basic form of auto insurance, required in most states. It covers damages you may cause to others in an accident, including bodily injury liability, covers medical expenses for injuries you cause to others. Property damage liability, covers costs associated with damage you cause to someone else's property. Collision coverage. Collision coverage pays for repairs to your car after an accident, regardless of who was at fault. This is especially important if you have a newer or more valuable vehicle. Comprehensive coverage. This type of coverage protects your car from non-collision related incidents, such as theft, vandalism, or natural disasters. It is often required if you have a loan on your vehicle. Uninsured/underinsured motorist coverage. This coverage protects you if you are involved in an accident with a driver who does not have insurance or does not have enough insurance to cover your damages. Factors affecting auto insurance premiums. Your auto insurance premiums can vary greatly based on several factors. Driving record. A clean driving record typically leads to lower premiums, while accidents or violations can increase rates. Type of vehicle. The make and model of your car can affect your insurance costs. High-performance or luxury vehicles generally have higher rates. Location. Where you live plays a significant role. Urban areas with higher traffic and crime rates often have higher premiums. Age and gender. Statistics show that younger drivers, particularly males, tend to have higher accident rates, affecting their insurance costs. Credit score. Many insurance companies consider your credit history when determining premiums. A higher credit score can lead to lower rates. Choosing the right auto insurance policy. When selecting an auto insurance policy, consider the following steps. Assess your needs. Determine what type of coverage you need based on your vehicle, driving habits, and financial situation. Shop around. Get quotes from multiple insurance providers to compare coverage options and prices. Understand the policy. Read the policy documents carefully to understand what is covered and any exclusions that may apply. Consider discounts. Ask about available discounts, such as safe driver discounts, student discounts, or bundling insurance policies. Maintaining your auto insurance. Once you have selected a policy, it's important to maintain it properly. Keep your contact and payment information up to date with your insurance provider. Review your policy annually to ensure it still meets your needs, especially after major life changes like moving, changing jobs, or purchasing a new vehicle. Consider increasing your deductible to lower your premium, but ensure you can afford the out-of-pocket costs in the event of a claim. Understanding auto insurance is essential for managing your personal finances effectively. By being informed about different coverage options, factors that affect premiums, and how to choose the right policy, you can make better financial decisions that protect your assets and ensure peace of mind while driving. Understanding renter's insurance. Renter's insurance is a type of insurance policy that provides financial protection for tenants against loss or damage to their personal belongings within a rented property. This insurance covers various scenarios such as theft, fire, vandalism, and certain types of water damage. Key components of renter's insurance. Personal property coverage. This component reimburses you for the loss or damage of personal belongings, such as furniture, electronics, and clothing, due to covered events. Liability coverage. This protects you in case someone is injured on your rental property or if you accidentally cause damage to someone else's property. It can cover legal fees and medical expenses. Additional living expenses. If your rental unit becomes uninhabitable due to a covered event, this coverage can help pay for temporary housing and additional living costs. Why renter's insurance is important. Many recent graduates may assume that their landlord's insurance covers their personal belongings, but this is typically not the case. Renter's insurance is crucial for protecting your assets and providing peace of mind. Policies are often affordable, making them accessible to new graduates who may be working with limited budgets. Understanding homeowner's insurance. Homeowner's insurance is a comprehensive insurance policy that protects both the structure of your home and your personal belongings. It typically covers the homeowner against various risks, including fire, theft, and natural disasters. Key components of homeowner's insurance. Dwelling coverage. This covers the physical structure of your home and any attached structures, such as garages or decks, against covered risks. Personal property coverage. Similar to renter's insurance, this component covers personal belongings inside the home, including furniture, appliances, and clothing. Liability protection. This protects you against legal claims for injury or property damage that you or your family members may cause to others. Additional living expenses. If your home is damaged and uninhabitable, this coverage helps pay for temporary housing and other living expenses. Why homeowner's insurance is important. Homeownership is a significant investment, and homeowner's insurance is essential for safeguarding it. It protects your property and belongings and provides liability protection, which can be crucial for avoiding substantial financial loss in the event of an accident or disaster. Choosing the right coverage. When selecting renter's or homeowner's insurance, consider the following. Assess your needs. Evaluate the value of your possessions and the level of coverage you require. Compare policies. Shop around and compare different policies to find the best coverage options and premiums. Understand the exclusions. Be aware of what is not covered in your policy, such as certain natural disasters or valuable items. Consider bundling. Some insurers offer discounts if you bundle renter's or homeowner's insurance with auto insurance. Understanding renter's and homeowner's insurance is essential for recent graduates as they navigate their financial independence. Choosing the right insurance policy can provide security and peace of mind while managing personal finances. Importance of insurance in financial planning. Insurance plays a crucial role in financial planning, especially for recent college graduates who are beginning to navigate their financial lives. Understanding the importance of insurance can help individuals protect their assets and ensure financial stability in the face of unforeseen events. Risk management. One of the primary functions of insurance is risk management. Life is unpredictable, and various risks can threaten financial security, including health issues, accidents, property damage, or even death. Insurance acts as a safety net, allowing individuals to transfer the financial burden of these risks to an insurance company. Types of insurance to consider. There are several types of insurance that recent graduates should consider. Health insurance. Essential for covering medical expenses, health insurance can prevent overwhelming costs associated with unexpected medical emergencies. Auto insurance. If you own a vehicle, auto insurance is required by law in most states. It protects you from financial loss in case of accidents, theft, or damage. Renter's insurance. For those living in rental properties, renter's insurance safeguards personal belongings from theft or damage, and it can also provide liability coverage. Life insurance. While often overlooked by young adults, life insurance can be crucial if you have dependents or significant debts, ensuring that your loved ones are financially protected in the event of your passing. Building financial security. Having adequate insurance coverage contributes to overall financial security. It ensures that individuals are not derailed by unexpected expenses that could otherwise deplete savings or lead to debt. This financial cushion allows for better planning and investment in future goals, such as home ownership, retirement, or further education. Peace of mind. Insurance provides peace of mind, knowing that you are prepared for the unexpected. This psychological benefit can reduce stress and allow individuals to focus on their personal and professional lives without the constant worry of potential financial disasters. Legal requirements. In many cases, certain types of insurance are legally mandated. For example, most states require drivers to carry auto insurance. Not having the necessary coverage can lead to legal penalties and significant financial repercussions. Long-term financial planning. Including insurance as part of a long-term financial plan is essential. Regularly reviewing and updating insurance policies ensures that coverage aligns with life changes, such as marriage, purchasing a home, or starting a family. This proactive approach helps maintain financial health and security throughout various life stages. Incorporating insurance into financial planning is not just about compliance or risk management. It is about creating a robust framework for financial stability. By understanding the importance of different types of insurance, recent graduates can make informed decisions that will support their financial well-being for years to come. Understanding risk management. Risk management is a critical aspect of personal finance that involves identifying, assessing, and prioritizing risks, followed by coordinated efforts to minimize, control, or monitor the impact of unforeseen events on your financial well-being. For recent college graduates, mastering risk management can help safeguard your financial future as you navigate the complexities of life after college. Types of financial risks. There are several types of financial risks that individuals may face. Market risk. The potential for losses due to fluctuations in market prices, such as investments in stocks or real estate. Credit risk. The risk of loss arising from a borrower's failure to repay a loan or meet contractual obligations. Liquidity risk. The risk that an individual may not be able to quickly convert an asset into cash without significantly affecting its value. Operational risk. Risks that arise from internal processes, systems, or external events that could disrupt your financial stability. Identifying risks. The first step in effective risk management is to identify potential risks that could impact your finances. Consider the following strategies. Conduct a personal financial assessment to evaluate your current financial situation. List potential risks such as job loss, medical emergencies, or unexpected expenses. Analyze your investments and savings to identify areas of potential market risk. Assessing risks. Once you've identified potential risks, the next step is to assess their likelihood and potential impact on your finances. Here are some techniques. Probability assessment. Estimate the likelihood of each risk occurring. This can be based on personal experience, market trends, or statistical data. Impact analysis. Determine the potential financial impact of each risk on your overall financial health. Risk matrix. Create a visual representation of risks by plotting them on a matrix based on their likelihood and impact. Mitigating risks. After assessing risks, it is crucial to develop strategies to mitigate them. Here are some effective approaches. Diversification. Spread your investments across various asset classes to reduce exposure to market risk. Emergency fund. Establish an emergency savings fund that can cover 3 to 6 months of living expenses to protect against unexpected financial shocks. Insurance. Obtain appropriate insurance coverage, health, auto, renters, etc., to safeguard against significant financial losses. Debt management. Develop a plan to manage and reduce debt to lower credit risk and improve financial stability. Monitoring and reviewing risks. Risk management is an ongoing process. Regularly review your financial situation and adjust your risk management strategies as needed. Conduct periodic assessments of your financial health and risk exposure. Stay informed about changes in the market or personal circumstances that may affect your risk profile. Seek professional advice when necessary to ensure you are making informed financial decisions. By understanding and implementing effective risk management strategies, recent college graduates can better navigate the financial challenges of early adulthood, ultimately leading to a more secure financial future. Understanding long-term financial security. Long-term financial security is a crucial component of personal finance that focuses on building a stable and sustainable financial future. For recent college graduates, achieving this security involves careful planning, disciplined saving, and strategic investment. Below are key concepts to consider in your journey toward long-term financial stability. The importance of long-term financial planning. Long-term financial planning allows you to set goals and outline steps to achieve them. It is essential to consider various life stages and events such as buying a home, starting a family, or retirement. By anticipating these milestones, you can create a financial roadmap that addresses your needs and aspirations. Budgeting, the foundation of financial security. Creating a budget is a fundamental step in managing your finances. It helps you track income and expenses, ensuring that you live within your means. A well-structured budget can also identify areas where you can save more, enabling you to allocate funds toward long-term goals, such as retirement or investments. Emergency fund, your financial safety net. An emergency fund is crucial for maintaining long-term financial security. It is advisable to save 3 to 6 months' worth of living expenses in a separate, easily accessible account. This fund acts as a buffer against unexpected expenses, such as medical emergencies or job loss, preventing you from relying on credit or loans during difficult times. Investing for the future. Investing is a vital aspect of building wealth and achieving long-term financial security. Start by understanding different investment options, such as stocks, bonds, and mutual funds. Consider opening a retirement account, such as a 401k or IRA, to take advantage of tax benefits and compound interest over time. The earlier you start investing, the more your money can grow through the power of compounding. Debt management. Managing debt is essential for financial stability. Focus on paying off high-interest debts first, such as credit card balances. Consider consolidating loans or negotiating lower interest rates to make repayment more manageable. Maintaining a good credit score can also lead to better borrowing terms in the future, contributing to your overall financial security. Insurance, protecting your assets. Insurance plays a significant role in safeguarding your financial future. Evaluate your needs for health insurance, renters or homeowners insurance, and life insurance. Adequate coverage can prevent financial devastation in the event of unforeseen circumstances, allowing you to maintain your long-term financial plans. Continuous education and financial literacy. Staying informed about personal finance is key to long-term financial security. Take advantage of resources such as workshops, online courses, and financial books. Understanding concepts like inflation, interest rates, and investment strategies will empower you to make informed decisions that align with your long-term goals. Setting and revising financial goals. Establishing clear and achievable financial goals is crucial. Whether it's saving for a down payment on a home, building a retirement nest egg, or planning for travel, having specific goals will guide your financial decisions. Regularly review and adjust these goals as your circumstances change, ensuring they remain relevant and attainable. Seeking professional advice. Consider consulting a financial advisor, especially when navigating complex financial decisions. A professional can provide personalized guidance based on your financial situation, helping you create a comprehensive plan that addresses your long-term security. This can be particularly beneficial. Navigating taxes. The basics of income tax. Understanding income tax is a crucial component of managing your personal finances effectively. As a recent college graduate entering the workforce, it is important to grasp the fundamentals of how income tax works, as it will impact your financial decisions moving forward. What is income tax? Income tax is a tax imposed by the government on the income earned by individuals and entities. This tax is calculated based on the income of the taxpayer and is typically collected by the federal, state, and sometimes local governments. The purpose of income tax is to fund various public services, including education, healthcare, and infrastructure. Types of income. Income can be categorized into several types, which may be subject to different tax rates. Wages and salaries, money earned from employment. Self-employment income, earnings from freelance work or business ownership. Investment income, income earned from interest, dividends, and capital gains from selling assets. Rental income, income generated from renting out property. Tax brackets. Income tax is typically structured in a progressive manner, meaning that as your income increases, so does the rate at which you are taxed. Tax brackets are the ranges of income that are taxed at specific rates. For example, 10% on income up to $9,950 for single filers, 12% on income over $9,950 and up to $40,525, 22% on income over $40,525 and up to $86,375. These brackets can vary based on your filing status, single, married, etc., and can change annually due to inflation adjustments. Filing your taxes. As a new graduate, you will need to file your taxes annually. Here are the basic steps involved in filing your income tax return. Gather documentation. Collect all relevant documents, including W-2 forms from employers, 1099 forms for freelance income, and receipts for deductible expenses. Choose a filing method. You can file taxes using tax software, hire a tax professional, or file by mail using paper forms. Complete your tax return. Fill out the necessary forms, reporting all sources of income and claiming any deductions or credits you qualify for. Submit your return. File your tax return by the deadline, which is typically April 15th in the United States. Deductions and credits. Deductions and credits can significantly reduce your taxable income and tax liability. Understanding these can lead to substantial savings. Deductions. Expenses that you can subtract from your total income, reducing your taxable income. Common deductions include student loan interest, mortgage interest, and certain education expenses. Tax credits. Amounts that directly reduce the amount of tax you owe. Popular credits include the Earned Income Tax Credit and the Lifetime Learning Credit. Tax planning. Effective tax planning can help you minimize your tax liability and maximize your savings. Consider the following strategies. Contribute to retirement accounts like a 401k or IRA, which may offer tax advantages. Keep track of deductible expenses throughout the year to ensure you claim all possible deductions. Stay informed about changes in tax laws that may affect your situation. Common mistakes to avoid. As a first-time filer, be mindful of these common pitfalls. Failing to report all income, which can lead to penalties. Overlooking available deductions and credits. Missing the filing deadline, which can result in late fees and interest charges. By understanding the basics of income tax, you can better prepare yourself for your financial future and make informed decisions about your money management strategies post-college. Understanding tax brackets and deductions. As recent college graduates step into the professional world, understanding the complexities of taxes is crucial for effective personal finance management. Two key concepts that every individual should grasp are tax brackets and deductions. What are tax brackets? Tax brackets are the ranges of income that are taxed at different rates. The United States employs a progressive tax system, meaning that as your income increases, the rate at which you are taxed also increases. Each tax bracket has a specific tax rate applied to the income that falls within its range. How tax brackets work. When you file your taxes, your total income is divided into segments that correspond to the various tax brackets. For example, if the tax brackets for a particular year are as follows: 10% on income up to $9,950, 12% on income over $9,950 to $40, $525, 22% on income over $40,525 to $86,375. If you earn $50,000, your tax is calculated as follows: 10% on the first $9,950, 12% on the income from $9,951 to $40, $525, 22% on the income from $40,526 to $50,000. Understanding deductions. Deductions are expenses that you can subtract from your total income to lower your taxable income. This can significantly reduce the amount of tax you owe. There are two main types of deductions: standard deductions, and itemized deductions. Standard deductions. The standard deduction is a fixed dollar amount that reduces the income on which you are taxed. For example, for the tax year 2024, the standard deduction for single filers is $14,600, up from $13,850 for 2023. This means if your total income is $50,000, you would only be taxed on $35,400, $50,000 to $14,600. Itemized deductions. Itemized deductions allow you to list specific expenses that can be deducted from your income, such as medical expenses, mortgage interest, state and local taxes, charitable contributions. To benefit from itemized deductions, the total amount of your eligible expenses must exceed the standard deduction. If it does, it may be more advantageous to itemize your deductions. Tax credits versus deductions. It is also important to differentiate between tax credits and deductions. While deductions reduce the amount of income that is subject to tax, tax credits directly reduce the amount of tax owed. For instance, if you owe $1,000 in taxes and have a tax credit of $200, your tax liability would decrease to $800. Strategies for managing your tax liability. Understanding tax brackets and deductions is vital for effective tax planning. Here are some strategies to consider. Maximize your deductions by keeping track of eligible expenses throughout the year. Consider contributing to retirement accounts, such as a 401k or IRA, which can reduce your taxable income. Stay informed about tax law changes that may affect your tax brackets and available deductions. Filing taxes as a recent graduate. As a recent college graduate, navigating the world of taxes can be overwhelming, especially if it's your first time filing. Understanding the basics of tax filing is crucial for managing your finances effectively. This section will guide you through the essential steps to file your taxes as a recent graduate. Gather necessary documents. Before you begin the filing process, it's important to gather all the necessary documents. Here are some key documents you will need. W-2 forms. If you were employed during the year, your employer should provide you with a W-2 form, which reports your annual wages and the taxes withheld. 1099 forms. If you worked as a freelancer or were self-employed, you may receive a 1099 form, which reports your income from these sources. Student loan interest statement. If you paid interest on your student loans, you may receive a Form 1098-E, which can help you claim a deduction. Receipts for deductions. Keep any receipts related to deductible expenses, such as education expenses or job search costs. Determine your filing status. Your filing status determines your tax rate and the deductions you qualify for. As a recent graduate, you will likely fall under one of the following categories. Single, if you are unmarried and do not qualify for another status. Head of household, if you are unmarried and have a qualifying dependent. Choose how to file. There are several options for filing your taxes. Online tax software. Many recent graduates choose to use online tax software, which provides step-by-step guidance and often offers free filing for simple tax situations. Tax professionals. If your tax situation is more complex, consider hiring a tax professional who can help you navigate the process. Paper filing. You can also file your taxes by mail using paper forms, but this method is slower and may result in longer processing times. Take advantage of deductions and credits. As a recent graduate, you may be eligible for various tax deductions and credits that can reduce your tax liability. Standard deduction. For the 2024 tax year, the standard deduction for single filers is $14,600, which means you can reduce your taxable income by this amount. Student loan interest deduction. You may deduct up to $2,500 of interest paid on student loans, subject to income limitations. Lifetime learning credit. If you are continuing your education, you may qualify for a credit of up to $2,000 per tax return for qualified education expenses. File your taxes on time. The deadline for filing your federal tax return is typically April 15th. If you miss this deadline, you may incur penalties and interest on any taxes owed. To avoid penalties, consider filing for an extension if you need more time, but remember that this only extends the filing deadline, not the payment deadline. Keep records. After filing your taxes, it's important to keep copies of your tax return and all supporting documents for at least 3 years. This will help you in case of an audit or if you need to reference your filing in the future. Resources for further assistance. There are many resources available to help you with your tax filing. IRS website. The official IRS website offers a wealth of information, including forms, instructions, and publications. Volunteer Income Tax Assistance. VITA. This program provides free tax help to people who make $60,000 or less, persons with disabilities, and limited English-speaking taxpayers. Local tax clinics. Many communities offer free or low-cost tax preparation services, especially around tax season. By understanding the tax filing process and utilizing available resources, you can confidently manage your taxes as a recent graduate and take a significant step toward mastering your financial foundations. Understanding tax planning strategies. Tax planning is an essential aspect of managing personal finances, especially for recent college graduates entering the workforce. Effective tax planning can help you minimize your tax liability, maximize your deductions, and ultimately keep more of your hard-earned money. Here are some key strategies to consider. 1. Understand your tax bracket. Your tax bracket determines the rate at which your income is taxed. As a recent graduate, it's crucial to understand where you fall within the tax brackets. This knowledge can help you make informed decisions about your income, investments, and deductions. The IRS updates tax brackets annually, so be sure to review them each year. 2. Utilize tax-advantaged accounts. Take advantage of tax-advantaged accounts such as 401k plans. Contributing to your employer's 401k plan can reduce your taxable income. Many employers also offer matching contributions, which is essentially free money. Individual retirement accounts. IRAs. Traditional IRAs allow you to deduct contributions from your taxable income, while Roth IRAs offer tax-free withdrawals in retirement. Health savings accounts. HSAs. If you have a high-deductible health plan, contributing to an HSA can provide tax deductions and tax-free withdrawals for qualified medical expenses. 3. Keep track of deductions and credits. Being aware of available tax deductions and credits can significantly reduce your tax obligation. Common deductions for recent graduates include student loan interest deduction. You can deduct up to $2,500 of interest paid on student loans, subject to income limits. Education credits. The American Opportunity Credit and Lifetime Learning Credit can help offset the cost of higher education. Moving expenses. If you moved for a job, certain moving expenses may be deductible, although rules around this have changed recently. 4. Consider tax loss harvesting. If you have investments in taxable accounts, tax loss harvesting can be a useful strategy. This involves selling investments that have lost value to offset gains elsewhere in your portfolio, thereby reducing your taxable income. 5. Stay organized and keep records. Maintaining organized records of your income, expenses, and tax-related documents throughout the year can streamline the filing process and ensure you don't miss out on deductions. Use digital tools or spreadsheets to track your finances and store receipts for any deductible expenses. 6. Consult a tax professional. While many tax strategies can be managed independently, consulting a tax professional can provide personalized advice tailored to your financial situation. They can help you navigate complex tax laws and identify opportunities to save. 7. Plan for future tax changes. The tax landscape can change due to legislation or personal circumstances. Staying informed about potential changes that may affect your tax situation, such as changes in income, family status, or tax law, can help you adjust your strategies accordingly. By implementing these tax planning strategies, you can take control of your finances and work toward achieving your financial goals post-college. Remember that tax planning is an ongoing process, and staying informed is key to maximizing your financial well-being. Benefits of tax-advantaged accounts. Tax-advantaged accounts are financial tools designed to help individuals save and invest money while minimizing their tax liabilities. These accounts come with various benefits that can significantly enhance your financial strategy, especially for recent college graduates starting their financial journey. 1. Tax deferral. One of the primary benefits of tax-advantaged accounts, such as traditional IRAs and 401k(s), is the ability to defer taxes on your contributions and any investment gains. This means that you do not pay taxes on the money you contribute or earn in the account until you withdraw it, typically in retirement. This can lead to substantial savings over time, as your investments can grow without the immediate impact of taxes. 2. Tax-free growth. Accounts like Roth IRAs and health savings accounts, HSAs, allow for tax-free growth. Contributions to a Roth IRA are made with after-tax dollars, but all earnings and withdrawals in retirement are tax-free, provided certain conditions are met. Similarly, HSAs allow you to save for medical expenses tax-free, making them a powerful tool for managing healthcare costs. 3. Lower tax bracket in retirement. Many individuals find themselves in a lower tax bracket during retirement compared to their earning years. By contributing to tax-deferred accounts, you can reduce your taxable income now and potentially pay a lower tax rate when you withdraw funds in the future. This strategy can maximize your retirement savings and reduce your overall tax burden. 4. Employer matching contributions. If you participate in an employer-sponsored retirement plan, such as a 401k, your employer may offer matching contributions. This means for every dollar you contribute, your employer may contribute additional funds up to a certain percentage. This is essentially free money and can significantly boost your retirement savings. 5. Flexibility in withdrawals. Some tax-advantaged accounts, like Roth IRAs, provide flexibility in withdrawals. Contributions to a Roth IRA can be withdrawn at any time without penalties or taxes, giving you access to your funds if needed. This can provide a safety net for unexpected expenses, making it a versatile savings option. 6. Estate planning benefits. Tax-advantaged accounts can also offer estate planning benefits. For instance, beneficiaries of IRAs and 401k can inherit these accounts without paying taxes on the balance at the time of inheritance. This can help preserve wealth for future generations while minimizing tax liabilities. 7. Encouragement of savings and investment. The structure of tax-advantaged accounts encourages individuals to save and invest for the long term. By providing tax incentives, these accounts promote a disciplined approach to financial planning and can help foster a habit of regular savings, which is crucial for financial stability. 8. Contribution limits and carryover. Many tax-advantaged accounts have annual contribution limits, which can help individuals manage their savings goals effectively. Additionally, if you do not reach the contribution limit in 1 year, some accounts allow you to carry over unused contribution room to future years, providing flexibility in your savings strategy. In summary, tax-advantaged accounts offer numerous benefits that can enhance your financial management skills as a recent college graduate. By understanding how to utilize these accounts effectively, you can build a solid financial foundation for your future. Keeping accurate records. Maintaining accurate financial records is a fundamental skill for recent college graduates as they transition into managing their personal finances. It enables you to track your income, expenses, and savings effectively, empowering you to make informed financial decisions. Why keeping records is important. Accurate record keeping provides several benefits. Budgeting. Understanding your spending patterns helps you create a realistic budget that aligns with your financial goals. Tax preparation. Keeping records of your income and expenses simplifies the tax filing process, ensuring you maximize deductions and avoid penalties. Financial accountability. Regularly reviewing your financial records fosters accountability and helps you stay committed to your financial objectives. Future planning. Historical data allows you to analyze trends, enabling better planning for major life events such as buying a home or starting a family. Types of records to keep. There are various types of financial records you should maintain. Income records. Document all sources of income, including salary, side hustles, and any other earnings. Expense records. Track all your expenses, categorized by type, e.g. housing, transportation, food, entertainment, to identify where your money goes. Bank statements. Regularly review your bank statements to verify your records and catch any discrepancies. Investment records. Keep track of any investments, including stocks, bonds, and retirement accounts, to monitor growth and performance. Receipts. Maintain receipts for major purchases and any deductible expenses, which will aid in tax preparation and budgeting. Best practices for keeping records. Implementing effective record-keeping practices can streamline your financial management. Be consistent. Set a regular schedule, weekly or monthly, to update and review your financial records. Use technology. Utilize apps and software such as spreadsheets, budgeting tools, or personal finance software to automate record keeping. Organize documents. Create a structured filing system for both digital and physical documents to ensure easy access and retrieval. Backup data. Regularly back up your records to prevent data loss. Consider using cloud storage for added security. Review and adjust. Periodically review your records to assess your financial health and make necessary adjustments to your budgeting or spending habits. Keeping accurate records is an essential skill for managing your finances successfully. By establishing a systematic approach to record keeping, you can gain valuable insights into your financial situation, leading to building wealth, the principles of wealth creation. Understanding the principles of wealth creation is essential for recent college graduates aiming to manage their finances effectively. Wealth creation involves systematic approaches and strategies that enhance your financial position over time. Below are some key principles to consider. 1. Start with a solid financial foundation. Before you can build wealth, it's crucial to establish a strong financial foundation. This includes creating a budget that tracks income and expenses, building an emergency fund with 3 to 6 months' worth of living expenses, eliminating high-interest debt, such as credit card balances. 2. Invest in yourself. One of the most effective ways to create wealth is to invest in your education and skills. Continuous learning can lead to higher earning potential through promotions and new job opportunities, improved financial literacy, allowing for better decision-making, networking opportunities that can open doors to new ventures. 3. Use the power of compound interest. Compound interest is a powerful tool for wealth creation. It involves earning interest on both your initial investment and the interest that accumulates over time. To take advantage of this principle, start saving early, even if it's a small amount. Contribute regularly to retirement accounts, such as a 401k or IRA. Reinvest dividends and interest to maximize growth. 4. Diversify your investments. Investing in a variety of assets can help mitigate risk and enhance returns. Consider diversifying across stocks, bonds, and real estate, domestic and international markets, different sectors and industries. 5. Live below your means. Adopting a lifestyle that allows you to save and invest more is fundamental to wealth creation. To live below your means, avoid lifestyle inflation as your income increases. Prioritize saving and investing over unnecessary spending. Focus on experiences rather than material possessions. 6. Set clear financial goals. Having specific, measurable, achievable, relevant, and time-bound, SMART financial goals can guide your wealth creation journey. Some examples include saving for a home down payment, building a retirement nest egg of a certain amount by a specific age, establishing a fund for future education or travel. 7. Monitor and adjust your financial plan. Regularly reviewing your financial plan is crucial for staying on track. This includes assessing your budget and spending habits, reevaluating investment performance, and making necessary adjustments. Updating your financial goals as circumstances change. 8. Seek professional advice when necessary. Sometimes, navigating personal finances can be complex. Don't hesitate to seek advice from financial professionals, such as financial advisors for investment strategies, tax professionals for tax planning and optimization, credit counselors for managing debt and improving credit scores. By understanding and applying these principles, recent college graduates can effectively manage their finances and lay a strong foundation for long-term wealth creation. Mindset and habits of financially successful individuals. Let's start with the mindset of financially successful individuals. Financially successful individuals often share a distinct mindset that sets them apart from others. This mindset is characterized by a proactive approach to money management, a commitment to lifelong learning, and a strong sense of self-discipline. Understanding and adopting these mental frameworks can significantly enhance your financial journey. Growth mindset. Successful individuals embrace a growth mindset, believing that their abilities and intelligence can be developed through dedication and hard work. This perspective fosters resilience, encourages continuous learning, and allows them to adapt to changing financial situations. Positive attitude towards money. A positive attitude towards money is crucial. Financially successful individuals view money as a tool that can help them achieve their goals rather than as a source of stress or anxiety. This healthy relationship with money enables them to make informed decisions and pursue opportunities without fear of failure. Long-term vision. Having a long-term vision is essential in personal finance. Successful individuals set clear financial goals and develop strategies to achieve them over time. They understand that building wealth is a marathon, not a sprint, and are willing to sacrifice short-term pleasures for long-term gains. Now let's examine the habits of financially successful individuals. In addition to mindset, habits play a crucial role in financial success. Developing effective financial habits can lead to better money management and increased wealth over time. Budgeting and tracking expenses. One of the foundational habits of financially successful individuals is budgeting. They meticulously track their income and expenses to understand where their money goes. This practice allows them to identify areas where they can cut back and allocate more funds towards savings and investments. Automating savings and investments. Automating savings and investments is a common habit among financially successful people. By setting up automatic transfers to savings accounts or investment portfolios, they ensure that they are consistently putting money aside without the temptation to spend it. Continuous learning and financial literacy. Successful individuals prioritize continuous learning. They invest time in understanding financial concepts, market trends, and investment strategies. This commitment to financial literacy empowers them to make informed decisions and adapt their strategies as needed. Networking and seeking advice. Building a network of financially savvy individuals is another habit of success. They seek advice from mentors, attend financial workshops, and engage with communities that encourage financial growth. This support system provides valuable insights and motivation. Mindful spending. Financially successful individuals practice mindful spending. They differentiate between needs and wants, making intentional choices about their purchases. This habit helps them avoid impulsive spending and prioritize their financial goals. Regular financial reviews. Conducting regular financial reviews is a habit that keeps successful individuals on track. They assess their financial situation, evaluate progress towards goals, and make necessary adjustments to their strategies. This practice fosters accountability and encourages proactive management of their finances. Continuous learning and adaptation. In today's fast-paced financial landscape, continuous learning and adaptation are essential skills for recent college graduates. As you embark on your journey toward financial independence, it is crucial to stay informed and flexible in your approach to managing your personal finances. The importance of continuous learning. Continuous learning involves actively seeking new knowledge and skills throughout your life. In the realm of personal finance, this means staying updated on various financial topics, such as budgeting, investing, credit management, and tax strategies. The financial world is constantly evolving, with new tools, regulations, and investment opportunities emerging regularly. By committing to ongoing education, you empower yourself to make informed decisions about your financial future. This could involve reading books and articles, attending workshops, or taking online courses related to personal finance. The more you learn, the more confident you will become in managing your money effectively. Adapting to change. Adaptation refers to the ability to adjust your financial strategies and behaviors in response to changing circumstances. Life after college often brings significant changes, such as starting a new job, moving to a new city, or taking on additional responsibilities. Each of these changes can impact your financial situation, making it essential to reassess and adapt your financial plan accordingly. For example, if you receive a salary increase, you may want to adjust your budget to allocate more funds towards savings or investments. Conversely, if you face unexpected expenses, such as medical bills or car repairs, you may need to reconsider your spending habits and prioritize your financial goals. Tools for continuous learning and adaptation. To facilitate continuous learning and adaptation, consider utilizing various tools and resources. Online courses. Platforms like Coursera, Udemy, and Khan Academy offer a wide range of courses on personal finance topics. Podcasts. Listening to finance-related podcasts can provide valuable insights and tips while you're on the go. Financial blogs. Follow reputable finance blogs to stay updated on trends and strategies in personal finance. Networking. Engage with professionals in the finance industry or join local finance clubs to share knowledge and experiences. Staying flexible in your financial planning. Flexibility is key to effective financial management. Your financial plan should be a living document that evolves with your life circumstances. Regularly review and adjust your budget, savings goals, and investment strategies to align with your current situation and future aspirations. Additionally, be open to exploring new financial products and services. For instance, if a new budgeting app or investment platform emerges that better suits your needs, don't hesitate to try it out. Embracing change and being willing to adapt will enhance your financial literacy and overall financial well-being. Continuous learning and adaptation are vital components of successful personal finance management. By committing to lifelong education and remaining flexible in your financial strategies, you will be better equipped to navigate the complexities of managing your money after college. Understanding long-term financial goals. Long-term financial goals are essential for recent college graduates as they lay the foundation for a secure financial future. These goals typically span 5 years or more and can significantly impact your financial stability and prosperity. Defining long-term financial goals. Long-term financial goals are specific objectives you want to achieve over an extended period. These might include buying a home, saving for retirement, funding your children's education, or starting a business. By setting these goals, you create a roadmap for your financial planning. The importance of long-term financial goals. Establishing long-term financial goals is crucial for several reasons: direction and focus. Having clear goals helps you prioritize your spending and savings, guiding your financial decisions. Motivation. Goals provide motivation to stay disciplined with your financial habits, encouraging you to save and invest wisely. Financial security. Long-term goals help build a safety net, ensuring that you are prepared for future expenses and emergencies. How to set effective long-term financial goals. When setting long-term financial goals, consider the following steps. Identify your goals. Think about what you want to achieve in the long run. Make a list of your aspirations, both personal and financial. Be specific. Clearly define your goals. Instead of saying, "I want to save for retirement," specify an amount you want to have saved by a certain age. Make them measurable. Ensure your goals are quantifiable. This allows you to track your progress and make adjustments as necessary. Set a timeline. Give each goal a time frame. This creates a sense of urgency and helps you stay focused. Evaluate and adjust. Regularly review your goals and adjust them as your circumstances change. Life events can impact your priorities and financial capabilities. Examples of long-term financial goals. Here are some common long-term financial goals recent graduates might consider. Buying a home, saving for a down payment and understanding mortgage options. Retirement savings, contributing to retirement accounts like a 401k or IRA. Education fund, setting aside money for children's future educational expenses. Debt repayment, creating a plan to pay off student loans or other debts. Strategies to achieve long-term financial goals. To reach your long-term financial goals, consider implementing these strategies. Create a budget. Develop a monthly budget that allocates funds towards your goals while covering living expenses. Build an emergency fund. Save 3 to 6 months' worth of living expenses to protect against unforeseen circumstances. Invest wisely. Research and choose investment options that align with your risk tolerance and time horizon. Automate savings. Set up automatic transfers to savings or investment accounts to ensure consistent contributions. Tracking your progress. Monitoring your progress towards your long-term financial goals is vital. Utilize tools such as budgeting apps, spreadsheets, or financial planners to keep track of your savings and investments. Regularly assess whether you are on track to meet your goals and make adjustments as necessary. Understanding homeownership. Homeownership is often seen as a key milestone in adult life and can be a significant part of financial planning for recent college graduates. Owning a home can provide stability, build equity, and offer potential tax benefits. However, it is essential to understand the responsibilities and financial implications that come with it. The benefits of homeownership. Equity building. Each mortgage payment increases your equity in the home, which can be a valuable asset over time. Stability. Owning a home can provide a sense of stability and permanence, as you are not subject to the whims of a landlord. Tax deductions. Homeowners may be eligible for tax deductions on mortgage interest and property taxes, which can lower taxable income. Personalization. Homeownership allows for customization of your living space, making it truly your own. Understanding costs associated with homeownership. Before deciding to purchase a home, it is vital to understand the various costs involved. Down payment. This is the upfront amount paid when purchasing a home, typically ranging from 3% to 20% of the purchase price. Closing costs. These are fees associated with finalizing the purchase, including loan origination fees, appraisal fees, and title insurance, often totaling 2% to 5% of the home price. Mortgage payments. Monthly payments that include principal and interest, as well as property taxes and homeowners insurance. Maintenance and repairs. Owners are responsible for all maintenance and repairs, which can vary significantly based on the home's age and condition. Preparing for homeownership. Here are steps to take to prepare for purchasing a home. Assess your financial situation. Evaluate your income, expenses, debts, and savings to determine how much you can afford. Improve your credit. Score. A higher credit score can lead to better mortgage rates. Pay down debts and make timely payments. Save for a down payment. Aim to save at least 20% of the home price to avoid private mortgage insurance, PMI, and secure better loan terms. Get pre-approved for a mortgage. Pre-approval gives you a clear understanding of how much you can borrow and shows sellers you are a serious buyer. Types of mortgages. Understanding the different types of mortgages is essential for making an informed decision. Fixed-rate mortgage. The interest rate remains the same throughout the loan term, providing predictability in monthly payments. Adjustable-rate mortgage. The interest rate may change after an initial fixed period, potentially leading to lower payments initially but higher costs later. FHA loans. These are government-backed loans designed for low to moderate income buyers, allowing for lower down payments. VA loans. Available for veterans and active military members. These loans often require no down payment and have favorable terms. Final thoughts on homeownership. Homeownership can be a rewarding endeavor, but it requires careful planning and consideration. By understanding the financial implications, preparing adequately, and knowing the types of mortgages available, recent graduates can set themselves up for success in managing their personal finances and achieving the goal of homeownership. Understanding passive income streams. Passive income refers to earnings that require minimal effort to maintain. Unlike traditional income, where you trade time for money, passive income allows you to earn money on an ongoing basis without constant involvement. This can be particularly beneficial for recent college graduates looking to build financial independence and security. Types of passive income streams. There are several avenues through which you can create passive income. Here are some popular options. 1. Rental income. Investing in real estate and renting out properties can provide a steady stream of income. This can include residential properties, commercial spaces, or even vacation rentals. It's essential to understand the responsibilities of being a landlord, such as maintenance and tenant management. 2. Dividend stocks. Investing in stocks that pay dividends can yield passive income. Companies distribute a portion of their earnings to shareholders in the form of dividends. By purchasing shares in these companies, you can earn regular payouts while also benefiting from potential stock price appreciation. 3. Peer-to-peer lending. Peer-to-peer lending platforms allow you to lend money directly to individuals or businesses in exchange for interest payments. This can generate returns while helping others access funds they need. However, it's essential to evaluate the risk involved, as borrowers may default. 4. Create an online course or ebook. If you have expertise in a particular area, creating an online course or writing an ebook can provide a source of passive income. Once the course or book is developed and marketed, you can earn money from sales without additional effort. 5. Affiliate marketing. Affiliate marketing involves promoting products or services from other companies and earning a commission on sales generated through your referral links. This can be done through a blog, social media, or YouTube channel. Building a following takes time, but it can lead to significant passive income. 6. High-interest savings accounts and CDs. While not the highest yielding options, high-interest savings accounts and certificates of deposit, CDs, provide a safe way to earn interest on your money. These are low-risk options that can serve as part of a diversified income strategy. Building your passive income portfolio. To create a successful passive income portfolio, consider the following steps. Assess your skills and interests. Choose passive income streams that align with your abilities and passions. Start small. Focus on 1 or 2 income streams initially to minimize risk and understand the processes involved. Diversify. As you gain experience, diversify your income sources to spread risk and increase overall earnings. Educate yourself. Continuously learn about the different avenues for passive income, as markets and opportunities can change. The importance of patience and persistence. Building passive income streams takes time and effort upfront. It is crucial to remain patient and persistent, as the initial stages may require significant work to set up the income-generating assets. Over time, however, the conclusion and next steps. Recap of key concepts. Budgeting basics. Creating a budget is fundamental for managing your finances effectively. A budget helps you track your income and expenses, making it easier to allocate your resources wisely. Key components of budgeting include income sources. Identify all your income sources, including salary, side gigs, and passive income. Fixed and variable expenses. Distinguish between fixed expenses, rent, utilities, and variable expenses, groceries, entertainment. 50/30/20 rule. A popular budgeting method where 50% of your income goes to needs, 30% to wants, and 20% to savings and debt repayment. Understanding credit. Credit is a crucial aspect of personal finance that influences your ability to borrow money. Key concepts include credit score, a numerical representation of your creditworthiness, typically ranging from 300 to 850. Credit reports, detailed reports from credit bureaus that outline your credit history. Managing debt, strategies for managing credit card debt, including the snowball and avalanche methods. Saving and emergency funds. Saving is essential for financial stability. Building an emergency fund should be a priority. Consider the following. Emergency fund goal. Aim to save 3 to 6 months' worth of living expenses. High-interest savings accounts. Utilize accounts that offer better interest rates than traditional savings accounts. Automating savings. Set up automatic transfers to your savings account to make saving easier. Investing fundamentals. Investing is key to growing your wealth over time. Important concepts to understand include types of investments, stocks, bonds, mutual funds, and real estate. Risk tolerance. Assess your willingness to take risks based on your financial goals and timeline. Diversification. Spreading your investments across various asset classes to minimize risk. Retirement planning. It's never too early to start planning for retirement. Key points include employer-sponsored plans. Take advantage of 401k or similar plans, especially if your employer offers matching contributions. Individual retirement accounts. IRAs explore traditional and Roth IRAs for tax-advantaged retirement savings. Compound interest. Understand the power of compound interest and how it can significantly grow your retirement savings over time. Insurance essentials. Insurance protects you from unexpected financial burdens. Key types of insurance to consider include health insurance, essential for covering medical expenses, whether through an employer or individual plans. Auto insurance, required for vehicle owners to protect against accidents and damages. Renters and homeowners insurance, protects your personal belongings from theft or damage. Tax fundamentals. Understanding taxes is vital for managing your finances. Key concepts include tax brackets. Know how different income levels are taxed at varying rates. Deductions and credits. Learn about available tax deductions and credits that can reduce your taxable income. Filing taxes. Familiarize yourself with the tax filing process, including deadlines and necessary documentation. Financial goal setting. Setting financial goals helps you stay focused and motivated. Consider the following steps. SMART goals. Set specific, measurable, achievable, relevant, and time-bound goals. Short-term versus long-term goals. Differentiate between immediate financial needs and long-term aspirations. Regular review. Periodically review and adjust your financial goals as your circumstances change. Resources for ongoing learning. Continuing education in personal finance is crucial. Valuable resources include books. Read personal finance books that offer insights and strategies. Online courses. Participate in online courses that cover various financial topics. Financial podcasts and blogs. Follow podcasts and blogs that provide ongoing financial education and tips. Resources for continued learning. Books. There are numerous books available that delve into personal finance topics, providing insights and strategies to help you manage your money effectively. Some recommended titles include The Total Money Makeover by Dave Ramsey, a practical guide to budgeting and debt elimination. Rich Dad Poor Dad by Robert Kiyosaki discusses the mindset and financial education needed for wealth building. Your Money or Your Life by Vicky Robin and Joe Dominguez offers a program for transforming your relationship with money. Budgeting 101 by Michelle Kagan, a beginner-friendly guide to understanding and implementing a budget. Online courses. Consider enrolling in online courses that cover various aspects of personal finance. Platforms such as Coursera offers courses from universities on financial literacy, budgeting, and investing. edX features programs that focus on personal finance and economics from reputable institutions. Udemy provides a wide range of personal finance courses from beginner to advanced levels. Websites and blogs. Many websites and blogs offer valuable information and personal finance tips. Some notable resources include The Simple Dollar, focuses on frugal living and smart money management tips. Mint offers budgeting tools along with articles and advice on personal finance. Budgeting for Beginners, a blog dedicated to helping individuals start their budgeting journey. Podcasts. Listening to personal finance podcasts can be a great way to learn on the go. Some popular options are The Dave Ramsey Show offers financial advice and strategies for handling money. Bigger Pockets Money Podcast discusses personal finance, investing, and wealth building. So Money features interviews with financial experts and personal finance stories. Financial tools and apps. Utilizing financial tools and apps can help you manage your money efficiently. Some recommended tools include Mint, a free budgeting tool that tracks expenses and helps set financial goals. In-Ab, You Need a Budget, a budgeting app that teaches users how to allocate their income wisely. Personal Capital, a tool for tracking investments and net worth, providing a holistic view of your finances. Community resources. Many communities offer workshops, seminars, and support groups focused on financial literacy. Check with local libraries, often host free classes and seminars on personal finance. Community colleges may offer courses in personal finance or money management. Nonprofit organizations, such as the National Endowment for Financial Education, NEF, provide resources and workshops. Social media and online forums. Engaging with personal finance content on social media platforms can provide ongoing education and support. Consider following X, formerly known as Twitter. Follow financial experts and organizations for tips and advice. Reddit, subreddits like r/personal finance and r/financial independence offer community advice and discussions. Facebook groups, join groups focused on financial literacy and support for shared experiences and advice. Even more books. Reading is one of the most effective ways to build your financial knowledge. Here are some essential books that can guide you in managing your money after college. The Total Money Makeover by Dave Ramsey. This book offers a straightforward approach to budgeting and debt elimination, providing a step-by-step plan to financial success. Rich Dad Poor Dad by Robert Kiyosaki. Kiyosaki shares lessons learned from his two dads about money, investing, and financial independence. Your Money or Your Life by Vicky Robin and Joe Dominguez. This book focuses on transforming your relationship with money and achieving financial independence through mindful spending. The Simple Path to Wealth by J.L. Collins. Collins provides easy-to-understand advice on investing and building wealth for the long term. Financial Freedom by Grant Sabatier. This book covers the journey to financial independence and practical steps to achieve it, including saving and investing wisely. Podcasts. Podcasts are a great way to learn about personal finance while on the go. Here are some recommended podcasts. The Dave Ramsey Show. This podcast features financial expert Dave Ramsey, who provides practical advice on budgeting, debt, and financial planning. Choose FI, focused on financial independence. This podcast discusses strategies for saving money, investing, and living a meaningful life. Bigger Pockets Money Podcast. This show provides insights into personal finance and wealth building through interviews with financially successful individuals. Smart Passive Income by Pat Flynn. This podcast explores various ways to create passive income streams and manage your finances effectively. The Money Guy Show. This podcast covers a wide range of financial topics, including investing, saving for retirement, and personal finance tips. Online courses. Online courses offer structured learning, and can be a valuable resource for mastering personal finance skills. Here are some noteworthy online courses. Financial Peace University by Dave Ramsey. This comprehensive course teaches budgeting, debt management, and financial planning strategies. Investing 101 by Coursera. This introductory course covers the basics of investing, including stocks, bonds, and mutual funds. Personal Finance Essentials by edX. This course focuses on key concepts in personal finance, including budgeting, saving, and credit management. Money Management for Millennials by Skillshare, a course designed specifically for younger generations to help them navigate financial challenges and goals. Financial Literacy for Young Adults by Udemy. This course covers essential topics like budgeting, saving, and investing tailored for recent graduates. Understanding Financial Advisors. Financial advisors are professionals who offer guidance on managing personal finances. They assist individuals in making informed decisions about investments, savings, retirement, and other financial matters. For recent college graduates, understanding when and how to seek the help of a financial advisor can be a crucial step in establishing a solid financial foundation. Types of financial advisors. There are various types of financial advisors, each specializing in different aspects of financial planning. Investment advisors focus on helping clients manage their investment portfolios. Certified financial planners, CFPs, provide comprehensive financial planning services, including budgeting, retirement planning, and estate planning. Robo-advisors, automated platforms that create and manage investment portfolios based on algorithms and user input. Choosing a financial advisor. When selecting a financial advisor, consider the following factors. Credentials. Look for advisors with recognized certifications, such as CFP or Chartered Financial Analyst, CFA. Fee structure. Understand how the advisor is compensated, whether through commissions, hourly fees, or a flat fee. Experience. Consider the advisor's experience and track record with clients in similar financial situations. Mentoring opportunities in personal finance. In addition to working with financial advisors, recent graduates can benefit from mentoring opportunities. Mentorship can provide valuable insights and guidance from experienced finance professionals. Finding a mentor. Here are some strategies to find a mentor in personal finance. Networking events. Attend local finance workshops, seminars, or alumni events to meet potential mentors. Professional organizations. Join organizations related to finance, such as the Financial Planning Association or local finance clubs. Online platforms. Utilize platforms like LinkedIn to connect with experienced finance professionals who may be open to mentoring. Building a mentorship relationship. Once you find a potential mentor, consider the following tips for building a productive relationship. Set clear goals. Discuss what you hope to achieve through the mentorship and establish clear expectations. Be open to feedback. Embrace constructive criticism and be willing to learn from your mentor's experience. Show appreciation. Acknowledge the time and effort your mentor invests in your development. The value of financial literacy. Whether working with a financial advisor or engaging in a mentorship relationship, the ultimate goal is to enhance your financial literacy. Understanding the principles of personal finance will empower you to make informed decisions and achieve